Good morning to you all. First, I would like to thank and welcome our esteemed speakers and participants. My name is Abdulaziz Deshti. I am the manager of Risk Management Group at Kuwait Gulf Oil Company, a subsidiary of KPC. It is my privilege to be the moderator of the 6th edition of Kuwait Enterprise Risk Management Conference. Over the past editions, this conference brought together ERM experts from around the globe to share with us the latest development in the ERM field, which were well received and appreciated. For this year's 6th edition, we have selected COVID-19 pandemic as the conference slogan due to its enormous global effect. Our esteemed speakers will be sharing their insight regarding the COVID-19 pandemic and ERM current issues and challenges. Please welcome Mr. Hashim, Chief Executive Officer at KPC, to give us his opening speech.
Bismillah ar-Rahman ar-Rahim. Distinguished guests, good morning. On behalf of Kuwait Petroleum Corporation, I would like to welcome you all to Kuwait's 6th Enterprise Risk Management Conference and the 6th event sponsored by KBC since 2012, and the first to be held virtually. Ladies and gentlemen, the disturbance caused across the world by COVID-19 showed the clear business benefit of managing risk from enterprise-wide perspective. This conference will focus on how to position ERM to add organizational value for all sectors in Kuwait in post-COVID era, addressing how ERM professionals can improve the existing risk processes and to share the best practices related to ERM value. Enterprise risk management is the process of planning, organizing, leading, and controlling the activity of an organization to manage all risk, including the effect of pandemic on the organization. Ladies and gentlemen, we are in the dynamic world. Events are evolving on a rapid pace, impacting various aspects of the industry, and COVID-19 has changed the world, impacting government, businesses, and industry. The only key to pass this challenge and the future challenges is by cooperation and collaboration. As energy is vital for the future well-being and prosperity of humanity, we at KBC believe in establishing partnership with a major oil company in order to deliver reliable access to affordable energy to the market and building a brighter energy future for all. In this competitive and dynamic environment, we expect TRM to support our effort to maintain sustainability and business continuity. Toward this objective, our KBC ERM 2040 strategy embraces a variety of initiatives such as building our capability in the area of governance, processes, people, and technology. ERM is a dynamic field of study, so we foresee a new technique and practices will become available, and the program will continue to evolve as the new leading practices are established, and we will be able to lead advancement going forward. Ladies and gentlemen, I hope this conference will provide a forum for sharing our learning, improving our ERM practices, and to help us achieve the comprehensive and value chain optimization. This year, we are honored to hold the first ERM virtual conference and have speakers from diverse background, region, and sector, including Kuwait Ministry of Public Health, Ministry of Petroleum of Saudi Arabia, Saudi Aramco, Qatar Gas, National Bank of Kuwait, reputable consultancy firm, along with representatives from KBC and subsidiary. On a final note, I would like to show my deep appreciation to the organizing team behind this conference and wish this event all success. A warm welcome once again for all of you, and thank you. and thank you.
Thank you, Mr. Hashim, for your valuable words. Please welcome Mrs. Shayma Al-Ghanem, Deputy Managing Director, Corporate Planning, and the Acting Managing Director, Planning and Finance at KPC, to give us her words.
Thank you, Khoyat Aziz. Good morning, everybody, distinguished guests, friends and colleagues. Assalamu alaikum. On behalf of Kuwait Petroleum Corporation, I welcome you all to Kuwait's Enterprise Risk Management Conference in its 6th edition. This event is sponsored by KPC since 2012 and the first to be held virtually. Over the years, the risk landscape has been continuously evolving and becoming increasingly complex as geopolitical tension, climate change, digitalization, economic, social, and other forces have been shaping the operational environment. Other forces have been shaping, the complexities have been turned a notch higher as the pandemic brought the entire world to its knees. Businesses around the world are reeling under the unparalleled economic shock of the COVID-19 pandemic. Although vaccination drives have started in a number of countries, it still seems a long way before organizations can return to business as usual. The pandemic has set off changes on multiple fronts for businesses around the globe, from amplified digital connection of people, processes, systems, and organization to frequent regulatory updates, remote working environments, social distancing, and beyond. This has a direct impact on the risk profile of organizations and has compelled them to rethink their governance, risk, and compliance functions. Oil production and prices are the primary risk faced by NOCs in the GCC region, followed by compliance, operational, and resilience risks. The accelerated pace of digital transformation, coupled with a remote working environment, has multiplied points of potential failures and security lapses. It is on these grounds that it doesn't come as a surprise that assessing the effectiveness of cybersecurity risk management is the top priority for organizations today. In addition, aligning risk priorities with business strategy emerged as a key challenge faced by organizations when it comes to enterprise and operational risk management, as business strategies and goals alter over time to adjust to evolving internal and external factors. It becomes critical to accordingly align risk priorities for successful risk mitigation. The pandemic has been a major driving force for companies to reevaluate their risk management programs and approaches in the past year. The need to adapt for a future-ready approach, a risk program that is agile, integrated, and technology-driven is no longer a matter of choice, but the only option for organizations to thrive in these uncertain times. The traditional approach to risk management that relied primarily on siloed processes is no longer relevant and effective. In today's fast-paced and complex operational environment, what business leaders want is a comprehensive and deeper visibility into the organization's risk profile, tolerance, and appetite, and the effectiveness of control frameworks and risk mitigation measures. This could be achieved by adopting an integrated approach to risk management that ties together various functions, audits, risk, compliance, cybersecurity, business continuity, and third party into one overarching framework. Implementing good ERM processes is a great need today, especially monitoring them on an exposure by exposure basis, paying close attention to aggregation of exposures across the entire business value chain. Proper risk culture is an organization enables management effectively deal with the uncertainty and associated risk while enhancing the capacity to build stakeholders' value by aligning the entity's risk appetite and strategies. At the end, this 6th Kuwait Enterprise Risk Management Conference will focus on how to position ERM to add organizational values for the oil sector in Kuwait in post-COVID era, addressing how ERM professionals can improve on the existing risk processes. We look forward to learning more from risk experts and industry practitioners on how to share the best practices related to ERM values. I would also like to appreciate the organization team behind this conference and wish this event all success. A warm welcome once again to all of you, and thank you. Thank you.
Thank you, Mrs. Chairman. Before we start, let's set some ground rules. All sessions will be recorded and will be available online after the conference conclusion. If you have any questions for the presenters, please use the chat feature at the Zoom webinar or the chat feature on the conference platform for each session. If there is time, the presenters will be answering some of these questions after the conclusion of their session. Also, an attendance certificate will be issued for those that attended all sessions over the next 2 days, today and tomorrow. Our first session is titled Leveraging Risk Management to Gain a Competitive Edge. Our first speaker, Mr. Haytham El-Ghais, is the Deputy Managing Director for International Marketing at KPC. Since joining KPC in 1993, he held several key positions in various international offices. In his current position, he provides KPC management, KPC board, Council of Ministers, the Supreme Petroleum Council, the Minister of Oil, with oil and gas market outlook reports and studies. He's actively involved in OPEC ministerial meetings, and since June 2017, he is the Kuwait governor at OPEC. Please welcome Mr. Ghaith to give us his presentation.
Thank you, Abdulaziz. Let me just put the screen online and make sure you can see it. Can you see this presentation?
It's clear.
Yeah, we can see it.
Bismillah ar-Rahman ar-Rahim. Good morning, distinguished delegates, everybody, friends and colleagues from KPC and from abroad. The fact that we're meeting today virtually speaks a lot about COVID-19 and what it has done to the world. So unfortunately, we can't be together to see each other face to face as we have done in the past occasions. But nevertheless, it's always great to get back and see old friends and meet new friends through this venue. Obviously, as mentioned by Mr. Hashim, our CEO, and echoed by Ms. Shema, that there is a very strong business case for enterprise risk management. COVID-19 is only one of many events that have happened over the past years, but I believe this is the most profound event yet that has really created a very strong business case for ERM, or enterprise risk management. Today, I'm going to be focusing on the impact of COVID on the oil market, on oil prices. I think that was underlined in the introductory speeches, and how market volatility can be overcome by adopting appropriate risk management techniques. But let me just start by reminding everybody and myself that really COVID-19 and the year 2020 was an unprecedented year. The global economy took a big hit, went into contraction. Oil markets were no exception. I think commodities all over the world, you name it, whatever it may be, in terms of commodities, whether it's currencies, whether it's shipping rates, everything was really brutally affected by COVID. And it's only appropriate that we take a step back, take stock of what happened through our enterprise risk management microscope, if I may use that term, and hope to use these lessons that we learned today and throughout tomorrow as well with the remaining speakers to be able to build a more resilient approach for the future. So let's just remind ourselves again about what happened with the global economy last year, and we are still suffering. Global GDP went through probably its worst downturn in history, with the average showing on the left side of this chart here, that global economic contraction of the rate of almost 4%. This is unprecedented. I mean, and to put it into context, this is a -4 or -3.8% contraction in the global economy, whereas we're usually used to seeing a positive growth of nearly 3%, 2% to 3% every year. So that had a significant effect on the global economy and on all commodities, oil included. And we see the usual supply demand and geopolitics events that have happened throughout history also taking their place and shaping the cycle that we are going through now. But also the dynamics have changed with the evolution of the energy transition that has now come into full force, it seems, and has its implications as well. We're now seeing, just as a side note, what people may argue may or may not be a cause of caused by the energy transition, the spike we're seeing now in commodity prices such as gas, coal, oil. But the bottom line is that the oil industry in the midst of all of this has really been redefined and reshaped, and itself is going through a true transition. We're now expecting to see almost 5% economic growth in terms of GDP this year to rebound from where the bottom was last year. Now, focusing this onto oil demand, as you can see on the chart again here, global demand for oil declined by almost 10 million barrels a day last year. This is again unprecedented, a big hit, 10% of global oil demand gone. We all remember the peak was during the beginning of the second quarter last year when COVID was at its peak. We saw in April and May, demand declined by almost 25 to 30 million barrels per day. A third of oil demand was eradicated, flights were grounded and still are to some extent. Transportation fuel affected, demand was affected, and the whole global economy and the whole cycle has been really, really impacted. Now we're seeing signs, yes, of positive recovery, as mentioned by Ms. Shema and our CEO. But I must caution that I don't think we are out of the woods. Global demand is expected to recover by around 5 to 6 million barrels per day, as you can see on the right-hand side here in the chart for this year. But you see, this still doesn't bring us back to pre-COVID levels. And it's expected that the whole year 2022, next year, is required. We need to add another 3 to 4 million barrels per day of oil demand growth to be able to reach the stage where we were pre-COVID. Now, what does this mean? We had a cycle of extreme volatility in oil prices, as the graph here shows. The events that have unfolded not only during COVID and because of COVID, but other events, as we mentioned, geopolitics, natural disasters, weather conditions, everything has played into reshaping the cycle of volatility. And I believe now, although prices have always been cyclical, but the cycles are becoming shorter and the volatility is ever more increasing, as we can see in this chart. And now, with this volatility in mind, we must also make the case that the volatility creates opportunities. So usually the term volatility is a scary term and people are frightened of volatility. But what we hope to demonstrate here today is that during COVID, in the peak of COVID, there were a lot of companies that made massive fortunes during the peak of this volatility through the proper utilization of appropriate risk management tools. And here I'm just showing some headlights of some of the world's top oil companies, how they have extracted huge profits and revenues, record profits actually for some of them, during the midst of the chaos and the carnage that happened in 2020. Now, there are many tools that these companies use to mitigate risks related to oil prices or the forward curve of oil prices. And to go through all of them, I would probably have to have a whole session that would cover the whole day. But I think the most simple case, and we'll just focus on this one, is storage. Now, storage is a very clear example of opportunities created during the pandemic, where market volatility was so extreme. We all remember in April 2020, when WTI fell into a negative territory. We had never seen something like that, minus, I believe, $37 a barrel. And during that period, there was actually opportunities created by playing the contango role, where people bought crude or products and stored. Demand was so low, storage was filling up, but people were becoming proactive, and companies started to take storage for commercial operations in order to optimize their operations and improve their value chain and their profits. So basically, this is onshore storage, and even offshore storage was being taken by many oil companies, where they could hedge the contango in the prices, where the forward curve shows that forward prices or future prices would be higher than the current prices, and the ability to store oil and make profit out of that, covering the storage cost, was a commonly and widely used tactic by many companies who generated huge profits during the peak of the pandemic last year. So, and this is not just limited to IOCs or trading oil companies. We see that asset-backed trading, using again the right risk management tools, is a common feature now, even in our region here in the GCC. Our brothers in Saudi Arabia, the Emirates, and Oman have already ventured off many years ago into that area of trading. We see now Aramco trading and Oman trading and ADNOC trading last year have increased their volumes and their abilities and capabilities in trading, and using the right risk management tools to complement their whole business cycle and the value chain, generating huge profits. And we see here on the right-hand side how international companies have grown over the years, and their volumes, traded volumes of oil and commodities, have increased year by year to also complement the whole value chain of assets that they own. And just to show you here, this is some of the profits made last year alone, and this is all publicly shared information. You can find it on the internet, on the Financial Times. Companies like BP made $4 billion last year just from trading and using the right risk management tools. Classic case, again, the example we gave about storage, but there are other examples that could be shown, like locational swaps, blending opportunities, all with the using of the appropriate risk management tools, which are commonly available today and widely available today in the industry. Also, some of the big trading firms like Vitol and others have made huge profits, record profits, through utilizing risk management tools during this pandemic, where it proved to be a very tough time for everybody in the business. Now, focusing back on our region, I think it's clear to see here the key messages by some of the leaders of some of the leading peers, our brothers in the region, talking about how the company's broader transformation to join arms between the marketing and supply and trading directorates, and how the companies are becoming more integrated in terms of integrating the whole operation between shipping, logistics, storage, and adding to that the element of trading in order to become key global trading companies, and optimizing the whole value for crude oil and refined products for some of them to be able to develop huge volumes and become some of the largest commodity trading companies in the world. So this is not just limited anymore to a certain distinct niche in the business of companies. Now it's becoming a common practice globally, and including in our region here in the Gulf. Now, of course, IOCs have been pioneers in this activity for many years in risk management, hedging their positions, hedging their businesses, and most of their trading has been done to complement their oil fields, their massive refineries, utilizing fleets of vessels. But as I showed earlier on, our brothers in the region here have also stepped up in their journey to follow suit and to leverage their value chain as well to invest in trading capabilities. And the table here below shows how companies that are deeply involved with risk management have been able not only to mitigate those risks, but also to generate additional potential revenues by trading. Now, it is not to say that trading does not have an inherent risk. Yes, there is a risk, but the ultimate objective is to minimize the risk and to mitigate the risk. So there are obviously key success factors that would be required to have a successful trading and risk management establishment or operation. And I think the most important is governance. Governance to monitor risk, to manage the risk, to have an independent risk committee, and to put compliance policies available in line with the business processes, to do frequent reviews that align with the company's strategy and the company's appetite for risk and its growth strategy. This is key and essential. But also important processes and controls have to be in place. There have to be documented processes that are embedded well into the system and constantly being updated to match the top class international companies in this field. Also, there is a requirement for robust internal control frameworks. This is critical in the setup of the organization. This includes a very clear segregation of duties across the business cycle. And of course, critical also is the empowerment of people to be able to deliver the commercial strategy of growing across the market and the products, and the development of manpower and the skills that are required to run such operations. And this has to be complemented with adequate market intelligence capabilities to be able to analyze the market well and decide and determine where the market is heading is critical for the success of such operations. Last but not least, equally, is the importance of having the best fit IT systems and technological business controls and processes in place, and the importance of data analytics. A lot of the data that's available there has to be analyzed, not only in the front office where the traders sit, but also in the mid office and in the back office. And this enables better scrutinization of deals done, processes that were implemented, and profits or losses, in order to be able to achieve better results as companies go forward. So I'd like to conclude my presentation by raising a question. Risk management, is it really a necessity or no longer a necessity? It's a luxury. And I believe, in view of the challenges that are around in the market today, as highlighted by the speeches made to introduce this conference, and my highlights that I've shown about COVID-19 and its impact, the challenges are growing, the volatility is increasing, there are more and more uncertainties as we venture off into the energy transition. And I believe personally, this is debatable, that the risk management and implementation of risk management techniques and methodologies are no longer a luxury, rather a necessity in order to ensure smooth business continuity and operations for all companies involved in the oil industry. And with that, I'd like to thank you for listening and conclude my presentation. And I'll be happy to take any questions whenever the time is suitable. Thank you.
Thank you, Mr. Al-Ghais. As usual, lots of good information and very informative. Please welcome Dr. Mohammed Al-Sabban. He received his PhD in economics from the University of Colorado. He worked as an advisor for the Minister of Petroleum and the Minister of Industry and Electricity in the Kingdom of Saudi Arabia. He participated in several OPEC meetings. He has extensive experience in the oil and gas field. So please, Dr. Mohammed, the mic is yours. Unmute, Doctor, unmute.
Can you hear me now?
Yes, we can. Tfadal.
Yes. Good morning, and thank you very much for inviting me. I would like to thank KPC for making this opportunity available to me. I am here speaking on my personal capacity. I am not an advisor to the Ministry of Petroleum anymore. I retired a few years ago. I used to be the head of the Saudi delegation for 30 years in climate change negotiations. And the big challenge that we are facing is not the COVID-19, as been said excellently by the previous speaker. That is a temporary challenge, a temporary incident, and it will come all the consequences that we have. However, climate change has been used to transfer the burden to developing countries, and particularly to those countries who are highly dependent on the exportation of fossil fuel, and in particular on the exportation of oil. The UNFCCC, which is the Convention of Climate Change, started saying we are calling for a comprehensive approach. Comprehensive approach means to reduce all greenhouse gases, not only CO2, as being stipulated in the Paris Climate Agreement, and in all economic sectors, and not only energy sector, and not only addressing addressing the sources of greenhouse gases, but also the sinks of greenhouse gases. Of course, Brazil and other Amazonian countries were rejecting to include sinks and to include deforestation because of their national interest. But I'm totally surprised to see that CO2 is the name of the game in the current Paris Agreement, and also energy sector is also the main target of the how to combat climate change. The problem is, even with this, we see that coal has continued to be subsidized by the industrialized countries and other large countries, and they are since they have huge reserves of the coal, and they are resisting. Now we started to raise the issue of coal to be equally treated with oil, and they are attacking oil producing countries that you are against the environment, against protecting the environment, forgetting that coal emits more greenhouse gases than oil and gas. The problem is, of course, is that they are talking now about carbon tax, but we have never have a carbon tax or a true carbon tax. A carbon tax, basically, when they talk about it, ends to be the simple gasoline tax. We have seen that discrimination or different treatment of the energy sector, of the energy sources, being biased against oil. In the meantime, of course, oil exporting countries like ours, GCC and others, we are trying to, we are not against renewable energy sources. We are not against combating climate change. However, we are against the hypocrisy by the West to implement it in a way to reduce dependency on oil imports. It's very simple. And we have seen President Biden, he started by saying, I will abolish oil and gas industry in the United States. But now he's gradually opening up the federal land for the oil industry to be to invest and invest more. Of course, at the same time, they are talking about there is a call for the border tax adjustment. And what they mean by that, any commodity that will be sent to the West or to industrialized countries, they will face high tariffs if they have GHG content in it. And that's really biased, because at the time when we are utilizing, or we are continue to have the oil and gas industries and coal industry in the industrialized countries, flourish and more investment there, they are penalizing developing countries as if they are transferring the whole burden of climate change to developing countries, and that's not acceptable. Of course, the current crisis, the energy crisis, because of the gas issue, is a major one, because it struck me that, well, if you call for international companies to stop investing in oil and gas exploration, then definitely with continued increase in demand, there will be a crisis and prices will be higher and higher. So I think from this point, we need to do two things as oil countries. One is that in the coming Glasgow meeting, we need to fight very hard to have a balanced and fair commitments. And let us remember that commitments are differentiated according to the Climate Convention. Those industrialized countries who advance much earlier than us, they need to bear more higher responsibility than developing countries. And this is according to the polluter pay principle. So they cannot equate commitments between developed and developing countries, and that is very clear in the convention. Secondly, there are many articles in the convention that we need to utilize, and including Article 4.8, which calls that those countries who are highly dependent on exportation of fossil fuel needs to be given high consideration, including transfer of funding, technology, etc. So I think we need to insist on having technology transfer to help our countries diversify economically, and also we need to have compensation, because we are going to be hurt a lot as developing countries. I think if I can see the last slide, the last slide shows that with the current existing tax structure in the OECD countries, we see taxes for more than 50% of the final composite barrel of oil. And we see that from very clear from the diagram that I have shown here. UK is more than 60%, etc., etc. Denmark also, and other countries. So in addition to these high taxes, they want to add more taxes under the name and under the pretext of carbon, that it is carbon tax. While still until now, many countries in the OECD countries are still subsidizing coal, and they are resisting coal from Saudi Arabia and other oil exporting countries to remove these subsidies and to impose carbon tax according to the carbon content. So this biasness in the climate policies internationally should be removed, and they should remove market distortion in order to have an equal level of treatment and not to transfer the burden to developing countries. It is a permanent damage to the oil industry, and I think this is the biggest challenge that we have as an oil exporting countries. We cannot continue seeing this biasness internationally, and our delegations to the Glasgow meeting needs to raise their voice, and this is a national interest that they need to protect. At the same time, domestically, of course, we need to expand on renewable energies. We need to diversify energy sources. and do the utmost in order to protect the environment. But at the same time, and Saudi Arabia and other countries are doing a lot in that field, and we can increase the greenery areas, including the initiative by Mohammed bin Salman to increase the greenery area by at least 10 billion new trees in Saudi Arabia and in the Middle East. So we are doing our job. We are doing what we need to do. However, and voluntarily, of course, we should not accept in Glasgow that there will be legally binding commitments on developing countries. It is very clear in the convention, and we need to continue. There is a major principle in the convention saying it is common but differentiated responsibility. We need to utilize this. Being quiet in the negotiations will not be helpful for our generation and future generation to come. Thank you very much.
Thank you very much, Dr. Salman. Very, very informative, and I'm pretty sure we'll be seeing you in future conferences regarding the same subject. Please now welcome Dr. Arno Gurken. Dr. Arno is the founder and long-term global leader of McKinsey Risk Management Practice. After 29 years with McKinsey, he has started his own independent consultancy. Doctor, you there?
Yeah, I'm here. Sorry, thank you very much. I was still struggling to share my screen here. Can you see the presentation and see me?
Yes, we see you and your presentation.
Okay, perfect. Thank you very much. I'm honored to be again invited. I think, Mr. Bali, I think I was joining you at the first and the second ERM conference back then. So it's a real privilege to be back now. Some of you may still remember I was indeed having the privilege to be the partner in charge in helping you launch the ERM initiative way back starting 2013 and 14. So some of my speakers before already mentioned the great challenges that the oil and gas industry is facing in the years to come, not only due to the changes that we're experiencing due to COVID, but in particular also due to what's now happening on the sustainability side. Mr. Mohammed Al-Shaban already pointed out that there is a lot of distortions that are going to happen, and in that regard will likely impact the oil and gas industry quite severely. As you can see, the Western world, starting in Europe, is very determined to move to an emission-free environment. This is not only to be viewed and seen by the dramatic amount of subsidies and money being spent by the governments. Alone, the European Union already has committed more than 1,000 billion in terms of money. But it's also to be viewed and seen through the dramatic development of new regulation, which I think Mr. Shaban, you already pointed out. So in that sense, we should all work under the hypothesis there will be dramatic changes about to come, and oil in its own right will be penalized quite significantly, be it through the emissions price tax or through regulation. You are probably also aware that the European Union is currently in the process of defining legislation that in the future will dramatically, one way or the other, penalize also imports that have a CO2 footprint. So in that sense, you even not only have the general trend, you also have some form of localization of regulation and penalization. We are also seeing that under the new Biden administration, there is a significant push in this direction in the US. And we are also seeing that China appears to also be speeding up into this direction, fair enough, starting more on the coal side, but also they have by 2060 claimed to be fully green. And that, of course, given this is the fastest growing economy globally, will have a dramatic impact. Mohammed, if you could move to the next slide, please. You will not be surprised, as I moved out of McKinsey, but still continue to be quite close to that institution. Actually, it's a normal process, and I'm called senior partner emeritus now of this firm, that a lot of the insights you will be seeing stem and are related to McKinsey findings still. So what you see in upstream is that there is indeed the perspective that demand for oil and gas will fade quite substantially. Many of your peers are moving into opportunities around carbon capture storage or carbon capture usage and storage. You will also have heard that the Biden administration is subsidizing CCS quite substantially. Some regions also are exploring hydrogen, of course, and moving into power. In fact, you are also seeing that many of your IOC peers, also in the region, of course, some of your players in the past already have moved quite aggressively into green power production themselves. Yeah. Yet, if we look at it, and someone showed it in the beginning already, current market prices are quite decent and okay, and that leads in many institutions to a situation where the head of upstream is saying, "Wait a minute, you are telling me that we should reduce capex in my business, yet this is where the return is highest and continues to be highest." CCS in many countries, as I said, is viewed as an opportunity, but in some countries you also continue to see that governments are penalizing it, are saying that it's not fully accepted. Hydrogen also appears a far out opportunity for many at least, whilst there's a lot of hype around it. So already for upstream, you can wonder, what is it really that is going to develop? And needless to say, given the money at stake here, the question as to how you move, how quickly you move, how much money you spend where, will be quite important for the fate and future of a company like KPC. Moving to downstream, you probably heard that an increasing number of OEMs has confirmed for fully carbon neutral cars. Actually, I think it was BMW that introduced the first fully carbon neutral car, both in terms of production and, of course, running it, including recycling of battery and so forth, the other day. That in its own right has had its merits. Yet, if you look at it, combustion engines are predominant and will continue to be predominant globally. And the peak of fossil fuels for car fleets, depending on the analysis you take, I didn't put it into the document here, is between 2030 or 2035. Again, depending on what you believe China is going to do and how quickly they are going to move. Then, if you take it on the other side again, all airlines, petchem companies and so forth, and I come to petrochemicals in a second, are under severe pressure to reduce emissions. So also here, you could argue maybe there's going to be some substantial substitution to green feedstock, new emission-free technologies in production. You probably heard about the deals that Martin Brudermüller, BASF, struck most recently, spending in total, I think it's 900 million on green power production in order to be able to run his crackers with green energy in the future in Europe. Yet, if you really look into it, there is, at least for Scope 3 emissions, there's definitely not enough green fuel available for a lot of time to come. And likewise, green energy is clearly not at that scope that will be required available. If you move into petrochemicals, regulation is starting with scope 1 and 2 emissions, and quite severe already in that regard. Yeah. Hence, companies are investigating CCUS, renewable energy, as I just pointed out at the BASF example. It is also clear that circular economy not only is a good opportunity in the sense that politicians want it, it's a must for the petrochemicals industry, because in particular for PP and PE, there will just not be sufficient virgin green feedstock available for a lot of time to come. Accordingly, you see a lot of push by starting petrochemicals companies, but also if you move over the pond to the Dows of this world. But as I already pointed out, there is not sufficient green feedstock available. It is very questionable how quickly that process can really be followed through. And if we look at recycling, that's all in pilot phase state rather than a reality. Could you move on to the next slide? Yeah, so this is probably an interesting curve for you. This is McKinsey research, and you can, of course, debate every curve. Yeah, but the perspective that McKinsey developed based on an econometric model is that the oil demand is going to be steadily falling with an accelerated pace after 2025. Gas will somewhat be a little bit more stable in terms of value pools. And that is simply due to the fact that given you have increased renewable power, you need continued volatility absorption through peaker plants production. And accordingly, that's why you need the gas. That said, the hydrogen curve, if you look at it, given the remoteness of advanced technology, is only picking up slowly, while CCS, we as a firm, i.e. McKinsey, believes to be a significant opportunity 2025 onwards. And as you probably know, there's a lot of things happening starting in the UK, in the US, but also Europe more broadly. If we could move on. So what you also have to keep in mind is if you take an industry perspective with regard to decarbonization, that not all industries will be feasible to completely decarbonize without using hydrocarbons. Yeah. So in that sense, in some of these industries, specifically in the cement industry, but also in the petrochemicals industry, at least for some foreseeable future, we clearly foresee a need to continue using hydrocarbons for some time. The only question is whether you have green fossil fuels that you can indeed use. That said, given there is such a shortage, the likelihood of burning it is dramatically low. Yeah? So in that sense, and that's why you see in those curves, that's the curves towards the end that I just showed you are flattening out. There will be continued demand. But if you believe in these trends, starting in the European Union and the US and China, then there will be significantly reduction of demand. Yeah. For example, the steel industry, you can easily is of course the wrong word, yeah, but you could indeed almost fully decarbonize without using oil in the future. We could move on. So it is not only the regulation that is driving this. Yeah, it is a very comprehensive push that we are seeing. And for my clients, I am currently and had to, over the last couple of months, really analyze the full ecosystem here. Yeah, it is starting on the equity capital market side as well. If you look at the number of funds that have moved to green criteria for CapEx investments, yeah, for their own investments, it is yet increasing dramatically. In fact, it is also true that most of these funds that have institutional investors that have moved into this strategy and direction do not have sufficient investment opportunities as we speak. As a consequence, you see a dramatic share price uptick for those companies that indeed can rightfully claim to have moved green compared to those that have not. Yeah. We did a very recent analysis comparing in the petrochemical space the share performance of all the different petrochemicals producers, and it's very clear trends that in the Western world, i.e., Europe and US, those that have a very clear green strategy and approach are thriving compared to those that are not. Yeah. Moves on to the debt capital markets. That said, that is the market where it has not fully hit the ground yet. What we're seeing is we see some spread advantage in the green bond space, but quite frankly, not as severe yet. And that is simply due to the fact that so far there's so much money out there looking for investment opportunities that the spreads in general are low and they continue to be low also for traditional brown investments. That said, based on an interview guide questionnaire that we did, it is also clear that there will be dramatic changes in the future. If you then move over to bank financing, if you could move to that page again, thank you, yeah. We are foreseeing a dramatic amount of regulation already hitting the banks, at least in Europe, but also in US. A recent survey that was done amongst the risk officers of the 20 most pronounced banks, that fair enough is tilted more towards the US and Europe in terms of participation, showed that almost all banks are implementing new lending policies as we speak that will penalize quite significantly brown institutions. It will likely be that around 20%, at least in Europe, 20% of new business of these banks will have to be granted to ESG compliant activities. That does not, of course, mean that it is not possible to be a company in the old paradigm and setting up specific vehicles that are more green to finance these vehicles. Then, yeah. We could move to the next page. This is just one example, and most of you will have seen how explicit BlackRock, for example, as one investor has become with regard to how they will penalize or appreciate if institutions move to a more green paradigm. And I can tell you this has dramatic implications, maybe even at least as much as the regulation and the government, yeah, in the board, in the C-suite, because they're hearing constantly from their investors the need for change as we speak. If we could move on. So if I could remind ourselves a little bit of what we did, and Bart, you were on the call, I think it was 2013, in launching our ERM vision. Yeah, we said at that point in time, ERM needs to help create an asymmetric risk return profile. Yeah, so we want to benefit more than experience the downside. And by the way, I really appreciated the trading presentation in the beginning. That is, of course, also to be viewed under this heading. We also said we want to increase the transparency on the oil price using our cash, which was at that point in time to be developed still, the cash flow at risk tool. We also said that we need to have a real input into the strategic direction. Yeah, what I have been talking about a minute ago is nothing but a very fundamental strategic question that the oil sector will now pose itself. And I'm sure you're having these intensive discussions as we speak. We also said that ERM needs to advance and will advance the skills and capabilities of the oil sector throughout. I'll come back to that. That's a very, very important point, I believe, in a minute. And we want to drive a culture of risk mitigation and fact-based improvement of risk-return decision-making in that regard. So taking all this, let me maybe on the next page show you what we are experiencing in the industry. This is again the distribution curve that we developed back then, and I think it shows still quite nicely the asymmetry for the positive of the cash flow at risk at that point in time for the oil sector. We are now doing these kind of curves throughout the industry, be it a chemicals company, be it an oil and gas company, be it further downstream companies. It's always the same. The tools and technology are the same we are using, yet the impact factors are, of course, changing dramatically. For example, we very recently, for a major oil and gas player, had to do this now for green power production and hydrogen. So what does this curve now look like if you add a significant business around hydrogen to it? Yeah, where we all know you have to put a lot of capex in now, and then assume that it will be paying off, hopefully, in the future. If you could move to the next page. So what are your peers doing? And as I said, it cuts across both upstream, downstream, petrochemicals. By the way, also logistics quite severely. So the first thing is all my clients have started to model the implications of do nothing. Do nothing in almost all cases implies a very, very severe and detrimental development of EBIT. Yeah, of course, depending on the underlying scenario that you imply. Then there is a second step where they're looking at immediate mitigation measures. And the point is that in these do nothing scenarios, the shorter implications for the next 2 years are not quite as severe. In fact, in upstream business, you can even give an oil price, you can even hope for some very positive cash flow. Yeah, in some of the polyolefins businesses, you can hope for some very, and currently are generating a lot of money. The question is whether at this point in time, the indication you're getting from short-term profitability is a good indication, like it always has been in the past, by the way, where to allocate and how to allocate your capex. So in that sense, it is important to now start modeling and using the technology you own at ERM to assess the different strategic moves that you can take. And at this point in time, this not only includes the traditional ones, this also includes the question of how and to what extent should and could we go, as I said before, into, for example, green power production, to hydrogen and so forth. What we are also doing in these other situations is applying the de-risking technique, portfolio of opportunities that we at that point in time developed at KPC. I can tell you that the reason why there's so much talk, in particular in the petrochemicals industry, around partnering opportunities, joint venture opportunities, is not only for the sake of funding these excessive investment requirements to turn around the oil and gas industry and the petrochemicals industries, it's also for the sake of locking in demand with customers and allowing them to buy into the assets through cross shareholdings. It is also for the sake of securing green power, for example, as I said, as I explained in the BASF green power deal that they struck with RWE and Vattenfall about to build 2 big wind parks in the southern North Sea. It is also about downstream players suddenly needing access for CCS opportunities to partner up. So you will see over the next years to come a dramatic reshaping of the industry at large. And what makes sense and what does not is so fundamentally important to model based on our toolkit here. It is finally also important in investor and regulatory communication, including the access to subsidies and government funding, which will be, as I said in the beginning, available in abundance. There's actually from the EU Commission, I forgot to mention, a money that has been set aside that is even threefold the money that already has been committed. Last not least, it is important to define this as an optimal stage approach, because clearly, given there's so much risks in here, you need to understand and model what you want to transfer and change when and how, given that your biggest cash contributors, at least with some of my clients, continue to be in key upstream businesses and key commoditized petrochemicals businesses, for example. Last not least, it is also important, coming back to the ambition that we had developed back then, to add the respective technology skills, because we are now starting to deal with completely new technologies. I'll give you one example. For a company that had to go into or wanted to go into green power production, the question whether a wind park is going to be profitable or not, of course, hinges on not only on whether you fulfill the capex plan that you wanted to go for, but also with regard to, while it's in operation, the technical availability. And 1 percentage point technical available plus or minus of such a wind park that usually is around 95-96% availability is going to determine whether that wind park is going to be profitable or not. So suddenly you have to deal with a complete new suite of risks that at least my traditional oil and gas counterparts are not used to. And finally, risk management now has a very, very important task to help aligning organizational responsibilities, organizational incentives. Because for a lot of time to come, and that is a minimum for 2-3 years, I would say, you will see a situation where the money will be generated more around the traditional products, yet you want to increasingly likely go for capex investments into new technologies that will only yield profitability later on. And in that sense, you can only imagine, and I'm sure you're having the same discussion, what's going on in others with your peers in the C-suite, where, for example, the head of upstream is saying that we need to, of course, maintain our investment thrust in upstream and traditional products, whereby potentially the petchem guy is saying, I need a lot of money to change directions here quite quickly and aggressively. So that would be a little bit of an overview that I wanted to give you in terms of what we see as dramatic changes that will impact the market, and how I am seeing the enterprise risk management function helping and facilitating the strategic changes here that companies are taking. Thank you very much.
Thank you very much, Dr. Arno. Since we have a bit of time, we will take some the questions that we got over the chat. The first question from Mr. Haytham Al-Ghais. The question is, what is KPC's position and strategy going forward regarding trading relative to its peers?
Thank you. That's a very good question. Actually, trading is part of KPC's strategic directions, definitely to get involved into this field. I cannot disclose full details, but definitely there are steps being taken in place within the company, within the organization, to move towards meeting that direction.
Okay. Thank you, Mr. Ghais. We have 2 questions for Dr. Mohammed Salman. Doctor, you're with us? Okay, the first question, what is neutral or natural, is it, yeah, neutral crude oil condensate? How are they produced as green energy? This is for you, Mr. Dr. Salman. You.
Hello?
Yes, did you, Doctor, did you hear the question?
I didn't hear the question, please.
Okay, what is the neutral crude oil and condensate? How are they produced as green energy? That's the first question.
Okay, in response to that, I think we have, as been said by previous speaker, the carbon sequestration technologies that can take the carbon out of the crude oil and be used, and the carbon can be circulated through the different economic sectors in order to have the greatest benefit from this decarbonization. So there are many other solutions that will come up, of course, but definitely we need to recognize the real threat. The real threat is not how to decarbonize oil. The real threat is the international pressure, especially from the OECD countries on developing countries to transfer the burden to them. So if we can succeed in alleviating that, and we are ready to pay our fair share, but not more than our fair share. So if we can press this issue internationally, then we will be okay with our oil. Regarding the previous speaker, he said, well, you can go to petrochemical and others. Let us not forget that the transportation sector, which is the main objective of the climate policy, constitute more than 65% of the total world consumption of oil. So it is huge. If they destruct the demand on this sector, then that's it. We will end up having very low prices, and also the demand, the huge supplies, lower demand, and that will be a disaster for developing countries, especially for IOCD. Thank you.
Okay, and there's another question for you, Dr. Salman. Can you please elaborate more on the meaning of technology transfer related to Article 48?
Transfer technology on concessional basis. That is the article, what the article says. But there is no mentioning of that in the Paris Agreement. They elevated, they were strong enough to stop developing countries from raising this issue. Of course, the issue of technology and funding are the main issues for developing countries. And we have seen that very little funding coming out of the OECD countries, very, transfer technology being transferred on commercial basis. So the burden is very high. And if we take only technology, why they are promoting renewable energy, basically it is their technologies. They want to sell it to us and they want us to pay for it. So they are the beneficial of such transfer technology. And I think that's fine. But to add to it, the other obstacles and other market distortion exist in OECD countries, that's unbearable.
Thank you, Doctor. We have a question for Dr. Arno. By transitioning from fossil fuel to green energy, that will have a big impact on inflation. Due to the low cost of fossil fuel, now will the nation be accepting this inflation? And he mentioned an example, that what happened in the UK when energy failure and spike in energy cost? Dr. Arno.
Sorry, I was still on mute. Yeah, that's a very important and very good question. Yeah, you probably heard there was an election very recently in Germany that strengthens the Green Party, which is very likely going to also form the future government. You're seeing it in the UK, as has been said. I think what you're going to experience is a lack of readiness to accept the economic consequences of going green, and what I continue to call muddling through, by which governments rather will try to curb prices, as you've seen in France, by the way, on gas prices currently, in order to mitigate the direct impact that it has, in particular on their constituents. At the same point in time, you should not believe that there is any way going back. The political pressure you have, in particular in Europe, but also in the US, is so dramatic that the process has launched and is starting. Yeah, so you will rather see, which of course I detest completely, but you will rather see a move away from liberal market paradigm and market pricing to a continued and even more highly regulated environment, with all the inefficiencies that it will yield, than moving back and moving away from the policies that are currently being crafted and drafted. That's at least my perspective.
Thank you. I have the last question does not address any of the panelists, but anybody can pick this up. The focus/action of BlackRock, etc., it's towards the visible big players in Europe with direct investors. How do you see the impact extending to the GCC and OCs? Who would like to take that up? Mr. Haytham, go ahead.
Thank you, Abdulaziz. It's a good question. Maybe I will not talk about the BlackRock itself, but bring into it another twist to the element of what my other colleagues, Dr. Arno and Dr. Mohammed, said. And I think this is a risk that people are really not paying too much attention to, which is the lack of investments that are really flowing into upstream, and especially upstream. And there's a fine balance that has to be struck between how much you invest as countries, as IOCs, as companies, to fuel the energy requirements globally that are, if we focus only on Europe or the US, is an issue. But if we focus on developing nations, like Dr. Mohammed said, we have Africa, we have Asia, we have China, a lot of places in Asia that are really fueling their economic growth on fossil fuels still, and more so on oil. So I think that balance has to be struck between how much decarbonization pushes away from investing into the upstream sector for the oil business and the oil and gas business, and how much we continue to fund and invest into the upstream sector and the oil and gas and energy sector to fund and to fuel this economic growth that we're seeing. Because if we don't have that balance, I really caution against a huge spike in oil prices in the future. We're seeing it already today in gas prices. Today, gas prices are in Europe and in Asia at $35 per MMBTU. To put this into context, it's around $200 per barrel. Now, if this continues, this has serious implications for the global economic growth, for inflation, for even the plans to decarbonize and move forward with this energy transition. So I think this is another risk element that we have to keep in mind, maybe as the rest of the speakers take it forward for the rest of the day and tomorrow. Striking that balance is critical. So I don't know if that really answers the BlackRock question, but I think it touches on some of the points that some of the speakers mentioned earlier. Thank you.
Okay. Thank you.
Yeah, if you want me to add,
Please do, Doctor.
It is indeed the path. The migration path is indeed an extremely critical one globally. Yeah. And to be honest, I'm not so worried about the next 18 months. Yeah. With most of my clients, we did the analysis, and it is very clear, in particular, an integrated player that has upstream all the way down to petrochemists like KPC should be able to fund the first wave of investments from free cash flow. Yeah, and I have not seen the numbers at KPC, of course, right? But that's what I'm seeing in other institutions. The real issue is going to be coming afterwards. And that's where the funding question hits us dramatically. And that's where the question is, how will prices in that situation for traditional gas and oil really be in the upstream space? And that's where, indeed, I would encourage KPC using the technology that Bart and team has developed, because you can only narrow it down by scenarios. That said, there will be, as I said, in the debt capital markets, there will be a clear trend to go green, but it will not be, at least from what I'm hearing and seeing, that from one day to the next, we are going to be running out of funds, because there's simply so much money out there looking for investment opportunities. Yeah, it could be that there will be an increase in terms of spreads that Treasury will have to pay at KPC to the street, but under all foreseeable scenarios that I have in mind so far, I would say for the next 3 to 5 years, things should be fundable. Yeah. That said, it has been said before, the question on emerging markets is a real one, right? So the region, I would hope, should still be quite safe and stable. But when it comes to emerging markets in Africa or what have you, that indeed could have some severe issues. And I had the privilege to talk to maybe the future foreign minister of Germany most recently. And there's a lot of worry around, in particular, Africa, that what could happen on that continent.
Thank you very much, Doctor. Now we'll take this timing perfect, and we'll move on to our next speaker, Mr. Bart Cornelson. I hope I pronounced that right, but I understand it's a very common name in Holland. Bart is an executive advisor with over 20 years of consulting services. Within Deloitte, Bart currently leads the energy, resources, and industrial practice across the client offering, such as consulting, financial advisory, tax, risk advisory, and audit. In the Middle East, he is also the oil and gas chemical leader. That's in the Middle East. And he's also the oil and gas chemical leader for North-South Europe. Never heard that zone, but...
No, it's part of our business, but I will... We don't need to go into detail how complicated sometimes people are organized. But thank you very much for the introduction, and my pleasure to be here. So I've been listening with a lot of interest to the previous speakers. I am going to provide, in some angles, I think, a slightly different perspective. So, and I think that's actually at the core of it, is that, and we're going to talk about it, nobody really knows. We can talk all about what are plausible futures, things that are happening, but they're all scenarios, they're options. Nobody has the silver bullet, nobody has the crystal ball to understand exactly what's going to happen. But I think we all were saying very clearly in the previous presentations that we are past a certain point. This is not going to go back anymore to a world that is dominated by hydrocarbons. Renewables are coming up. There is pressure very strongly from the Paris Agreement, of course, society, investors, people really, if you look now at, even in the region, like an initiative like One Planet, launched by the sovereign wealth funds, the impact on our industry, on the hydrocarbon industry, is going to be significant. And at the same time, also technology with some of the developments and innovations have happened, make it a lot easier to move on. And we also see not only kind of at the macro level, but what is happening also at a more micro level on the way the sector is behaving. Is one, it's becoming more customer centric. It's going to be more important, like how do customers really behave? And you saw that in some of the questions asked around, are people willing to pay for this? Are people willing to pay for renewables or for cleaner energy? We also, what we see at the same time is a greater efficiency, and primarily that driven by technology. Electrification, although we always, when people talk about electrification, we have to be realistic that there are a lot of sectors that are hard to abate. And I would recommend all of you, we just finished the third one in our series that we're doing with Shell. We've done actually now road freight, we've done shipping and aviation to actually look at how could we as sectors actually change? How can you address even the hard to abate ones? Because electrification will get you only less than halfway. Then talk about abundance. What is changing also is there's more and more renewables coming into the market. We see it also with projects with all the drive on hydrogen. And then in the end, the questions around decentralization. And I think you see some of that very clearly happen in countries like Germany, where Dr. Arno is from. But questions also around sustainability. And what is very important is the regional dimension. And I think we have to be very mindful, and I have to reflect upon always that myself, is that I'm from the Netherlands and I might take a Netherlands lens on the rest of the world, but that doesn't mean it's right. It's different regions behave very, very different in this energy transition. And I think that's where a lot of the questions came about, is about like, how do we predict this? How do we actually think what is going to happen in the world? And this came from a study done by Oxford a little bit back, is there's actually two ways of looking at this. And all of it becomes almost like a belief. What do you think it's going to be? Do you believe it will pick up? Do you think consumers are ready or not? Are you believing there will be increasing innovation in distribution and storage? Will there be? All of this is a trade-off. It's like you don't really know. And I think that's where the challenge comes in, is how do you then as an organization, how do you deal with that? How do you deal with that uncertainty? Because you still have to make capital decisions. You still have to do right for your shareholders. You have to do right for the general public. And you also need to think about long-term resilience and robustness of your portfolio. And what we did to address that is to actually look at what is the future energy going to look like? What are some of the plausible scenarios in this space? And this is done by a team that we have internally that have actually founded a lot of the scenario thinking. Many of them also associated, including myself, with the team that works at Shell. So I've had the pleasure that before coming to the Middle East a number of years ago to actually do all the modeling where Shell started to make trade-offs in its portfolio, not only between capital investments and returns, but actually added net carbon footprint as a third dimension. So, and I think what makes our scenarios a little bit different, the way we think about it, is we're looking at the whole system. So not just at production or demand, but really the whole system. We put humans at the center. And I think that's where all of us are trying to predict human behavior. At the end of the day, and COVID has given us a glimpse of how human behavior can change very quickly, but at the end, that's what's going to happen. People will decide what they want to do. Do we know that's going to be a quick decision? Is it going to be the same in every region? Do we know which direction? No, we don't. And that's where the scenarios come in to actually provide some robustness to your decision making. We focus on the near term because I don't think that too far out you can really predict, because it becomes very difficult to think way beyond the time that I'm going to be alive myself. It's like around like so you really have to think about like more the near term. And then what are some of the uncertainties, the things that we can't predict, but what are the different axes as a result when we do this assessment? And we really brought it down to like two key axes. One is, how does society respond to climate change? That's from the top to the bottom. And then look about also, how global are we going to be? Are we going to be very nationally oriented, very regional, or are we going to be very open and collaborative as a global economy? And the interesting thing is like when you see this, the first instinct, and I have the same instinct to say, okay, which one do I think it's going to be? That's actually not entirely the way to look at it. You should think about, these are all plausible futures, but they have all very distinct impacts on different sectors in the energy system. So, and we then have to, knowing that uncertainty, what the future might hold, come to very different conclusions. And that's really, when we think about this, is that in each of these scenarios, there is actually different roles for different technologies. There's different impacts on how fast the energy transition will go. And I won't bore you today with all the details, but underlying, we have economic forecasts and everything associated with this. I'm happy to share that with anybody who's interested, but it really shows that if you think about in which scenario would the energy transition go the fastest, that's the one team, one dream. That's when you get global collaboration. And the least would be in the me and my resource, where there's a lot more local thinking, but also a lot more holding on to hydrocarbons. But you do see, particularly, and I think there were comments made earlier about the emerging markets, the different regions, and that's what we see with rising tide, where we actually see, yes, there's more of a global, but it's a global shift. And as a result, what we're seeing is a very different behavior. And as a result, far more focus on fossil fuel efficiency than actually on energy transition. But the one thing, and I think it resonates also with what previous speakers have spoken about, is there is an imperative to decarbonize. It's the continued climate change will create that. Consumers can and will drive meaningful change. And we've seen that with the pressure right at the beginning during COVID, when there was a massive drop in demand, like effectively refineries in the US going back to the levels of the Nixon era, if you think about their output. We do expect a slowing growth, a decline in CO2 emissions. Declining growth of global energy demand, but that's very dependent on global and public-private collaboration. Renewables will grow fast, but we do see a reliance still very much on hydrocarbons in all the different scenarios. And particularly on the power generation side, we need policy support to keep pace with the demand, because you need that drive. Particularly, we have seen that, particularly in Northwest Europe, it's to kind of be the launching customer, to be the one who drives that, if you think about solar or wind. And then the role of China and other developing nations. They will have a significant and probably even a disproportionate impact. But what do we see people do? What do oil and gas companies do in this world? And you don't know what the future is going to hold. You want to make decisions. And one of the things that we're seeing is very much a drive towards decarbonization. And I've just put a few companies up here. I could do the same for many others, but you do see differences. It's where, for example, Shell very much wants to be a leader. They actually really want to drive not only scope 1 and 2, but also scope 3 down. That's where you see all the drive now for them to get in sustainable aviation fuel, the drive in shipping and road freight and hydrogen. That's all driven by actually wanting to own and drive the full value chain. You see that far less, for example, with companies like Exxon, who have far more a focus on scope 1 and perhaps even 2. But that commitment we've seen with all. it's in the outside of the region. In the region, it's a bit more complicated, but outside, it's very much a drive towards decarbonization. And what does that really mean? It's because there's it's a nice little buzzword, but we need to think about it. What does it mean really as an organization or a company? One is about reducing the energy and the emissions of the existing operations, which is really about reducing energy consumption. And let's oil 25 to 50% of the energy the cost is actually associated to energy. Switching to lower carbon energy using solar panels and others, capture carbon, and sequester and offset. That's one bucket. And I think in many ways, many of the organizations in the oil and gas industry can do this even just from an operational efficiency perspective. As energy is such a tremendous part of your cost base, you can actually use a lot of the continuous improvement and other initiatives you have, but now take a different lens. Not only look at the cost, also look at the carbon footprint that you could potentially reduce. But then we see the second part, which is entering in the low carbon businesses. And that's thinking about getting into electricity. We see oil and gas companies rebranding themselves into energy companies. Thinking about lower carbon fuels, as I mentioned earlier, sustainable aviation fuels or biofuels, thinking about specialty products. But really, and this is where in the region now, a lot of the discussion you hear is around hydrogen. And that is not only has an opportunity, and I think hydrogen is a very interesting one for the region, because it has an opportunity not only to prolong the life of the assets you have, particularly we're looking here at blue hydrogen, but also an opportunity to lower your carbon footprint. And we've seen already a number of initiatives in different countries. In Saudi Arabia, for example, all the work at NEOM. If you see the recent announcements by Mubadala, ADQ, and ADNOC, it's some of the pilots they're running. It's really an area where I think the region is catching up. And as I said, this is important because energy represents anywhere, and it depends a bit which field, 20 to 50% of your operating costs. So energy is not only about the footprint you have, it's also around the opportunity to actually reduce your costs significantly and create an environment in which, and we talked a bit about in the previous presentations around how fast will this go, but we do have to realize there is going to be at some point a last man standing. And who will be the one last standing is the one who can produce the oil the cleanest and the cheapest. So there is a need to get that done also. And why and how can we do this? Is really think about the opportunities that we have at a corporate side, but also like very energy specific at the different operations and the assets that we have. And that's when we think about this, what does that mean? The intensity reduction. You see very clearly a company like Total being very aggressive when it comes down to that. What is interesting though, if you do this chart and you do this every couple of months, you will see everybody shifting to the right, because the pressure politically and socially on these IOCs is going up. It's not releasing, so they will be continuously pushed to do more. You might have heard that Shell even lost a court case in the Netherlands where they were told their plans were not aggressive enough by the judge and they had to get back to the drawing board. So you see society putting a tremendous amount of pressure on these organizations to do things differently. And how can you think about that if you think about reducing your emissions of your existing operations? How do you succeed in that space? And it's really questioning around, and there's not a right answer, but each of the organizations thinks about, how do you think about innovation? What kind of model do you need for that? And then above all, how are you going to execute that? And that can be an ecosystem that can be on your own. It can be by buying technology, it can be by developing your own. And what we're seeing is that different organizations take different approaches to here, really based on one, their scale, their expertise, and also their views on how fast this will go. And you see the interpretations between the different oil and gas companies being significantly different. So there is not one right way. I think in the end, everybody 2020 hindsight will say, we got it right. But to be honest, nobody really knows as of now. But then equally, how do people think about entering low carbon businesses? And there you see really again some of the large IOCs come in. To give you an indication, when I worked with Shell, they were doing up to 2 billion a year in new energy investments, and they really now with doing North H2, which together with Equinor, which is the largest hydrogen project in Europe, and depending on how you look at it, potentially even in the world. And that's very much going from wind to hydrogen, and then of course in partnership at this moment very much with the steel industry. But what do I think overall? What are some of the key takeaways? Is across the oil and gas value chain, there is really uncertainty, and the oil prices will get trapped between softer demand and the equity markets, and this will go up and down. And depending on what exact time I will do a statement like this, I might be a little bit less right or a little bit less wrong, but we need to look at it long term. We do see a lot of uncertainties going to come into the market. It's also what initially when COVID-19 happened, there was a lot of discussion, especially with the oil price going so low. Will this actually slow down the long-term trend towards decarbonization and renewables? And the answer is it hasn't. If you look socially, politically, the pressure has only increased. It hasn't gone down. That's why what we said, we really look at this and the future of energy from a scenario lens. Think about this about 4 plausible but very different scenarios, and think about what that might look like for you. Don't try to find the right answer, but think about how can you minimize risk and maximize your opportunities within that uncertain future. The other one is that resiliency is not a choice. You can't choose and to deny that there is this transition happening. And I've seen that happening where people said, this is not happening, it's going to be beyond my time. The problem is you take decisions today for your organization that's going to hold for decades to come. So you need to take this into account. You need to think about what is that path to decarbonization going to look like and what role we're going to play in that. So on that note, thank you very much. And I'm happy to take any questions.
Yeah, we have, thank you very much, Mr. Bart. And we have a question, I guess, specifically for you. Can you please elaborate when you say China and the developing nations action have a disproportionate impact?
What I mean with that is if you think about the energy consumption in China and the size of the country, when they make a decision, it's going to be a big switch in the global landscape. So proportionate, they make a far bigger impact on decisions than, let's say, a country like the Netherlands. That's one. And the other one is that they are the countries that are still behind if you look at it from an energy consumption per capita. Like earlier, there were questions around, I think Dr. Arno was talking about Africa. It's what happens when these countries start catching up? What will they do? Will they leapfrog and skip steps, or will they actually go towards a future that is first still oil and gas, and then to renewables. And that's to be seen, but that has, of course, tremendous impact, far more than some of the more mature systems like Europe and North America.
Okay, we have another question. I guess that would be for any of the panelists. What opportunities can oil developing countries explore out of climate change accords?
If I may answer that, I think one of them is actually looking at hydrogen. How do you, because the amount of hydrogen needed in the world is far greater than in the next decades green hydrogen will be able to deliver. So there is a tremendous opportunity for blue hydrogen. So a combination of them, using hydrocarbons with carbon capture and storage, and in that sense, prolonging the use of your natural resources, while at the same point in time, reducing the impact on the global carbon footprint. I think hydrogen is there are current forecasts that it could be up to 20% of the energy system. Now, if you think about it, electrification is about 40-45. You can kind of see what opportunity hydrogen potentially can hold for this region.
Thank you very much, Bart. We'll move on. We'll leave some of the questions till the end of the session. We'll move on to our next speaker, Mr. Grant Griffiths. His bio is very elaborate, so I'm going to try to, give him a fair share. Grant is a non-executive director, transformation leader, and advisor, specializing in risk management, ESG, and sustainability, who has held a senior leadership advisory role in developing strategic resilience for ASX, LSE, Euronext, New York Stock Exchange, NASDAQ. He is a member of the Institute of Directors and the Institute of Strategic Risk Management. Grant, the floor is yours.
Thank you, Abdulaziz. Thank you for that wonderful introduction, and thank you to all the speakers so far. And really a hard act to follow. And first of all, also I'd like to say thank you to Dr. Mohammed Al-Anesi for organising the conference, and to KPC for your ongoing support of risk management and the global risk management community. So it's really great to see that we have such interest shown in an area that I'm very passionate about, and I've spent a lot of my career working in. And Bart, you said you're coming at it from a Netherlands lens. Well, we're going to have it from a little bit of an Australian lens, or to be more accurate, the Aussie at large. So I spent the best part of 20-something years now, for most of that, living outside of Australia, my home country. And it's interesting because sort of going back, and when I look back at what I've done and where my career started, now some of you may recognise this map. It's not very exciting for many people, but it's the Bowen Basin, or actually it's part of Queensland, and we've got things like the Bowen Basin, the Surat Basin, and many other basins. And of course, they're very renowned for coal and to a lesser extent for gas. And but in recent years, certainly gas production has been something that's been stepped up in that part of the world. So, really things like hydrocarbons are something that I've grown up with, and I started the early part of my career working in that industry, so I have a great affinity for it. And I think that it's fair to say, I run the risk here, pardon the pun, of saying that I'm probably one of the sort of people now who are old enough to appreciate the role that hydrocarbons play in everyday life. And I do firmly believe that there will be a very strong and relevant role in the future for hydrocarbons. Now, that said, we've heard everyone else speak today about some of the challenges and the opportunities that we face as an industry, and particularly when we're looking at risks and we're looking at the whole ESG agenda and everything else. And I think earlier on, Dr. Al-Salman made a very good point, excellent points actually, about the perspectives of climate change and how it's viewed. This actually came up 2 weeks ago. I was doing some ESG work with an organisation in Southeast Asia that represents a number of very large companies as well as unlisted companies. And someone on there who actually is the ESG person for an organisation with a lot of investments made the very same point, and said, he went a little bit further and said, I really think we have these Western targets being imposed unilaterally around the world, and we're not always taking into consideration the unique local and regional needs of many countries and many parts of the world that really rely on things like hydrocarbons and other natural resources as a means of growth. And I'm going to touch on that a little bit more in a moment. So I just wanted to put a little bit of context around it. I mean, most of you will know it's a coal mine, an open cut one. We also have a lot of underground coal mines here in this part of the world, and exporting of coal has been a very big industry and continues to be so, not just for power generation, but for steel production and a whole range of things. And of course, we have the oil fields, and we have the offshore oil rigs, and I think, and of course we have all of the processing associated with that. And I think it's particularly with COVID-19, one thing that's become evident, we got to a point, and I think Bart, you touched on this point, as did many others, that we looked at COVID-19 and we just got to a point, I think globally, we started to accept that we could be a little bit more efficient and a little bit greener and environmentally conscious in our everyday lives. So we were getting used to the concept of recycling, of using reusable containers for everything from food to beverages and a whole range of other things in our lives. COVID-19 comes along, and what do we have to do as societies? We have to think about basic hygiene and public health. And so we need to then start to look at what do we do? We need to go back to lots of wrapping and hygiene processes and face masks and everything else. So we sort of, in a number of ways, COVID-19 has taken us back a few steps from that aspect when we talk ESG on the E and S side of things, and especially the E. But interestingly, as many have already pointed out, COVID-19 also focused us on what we could achieve when we become a little less reliant on energy, a little bit more efficient, and indeed complete ways of behaviour and engagement with industry and society change. So we've proven that we have agility and inbuilt agility as humans and also as society. And so things like, we mentioned digital transformation. I mean, the digital transformation is really accelerated, as well as the energy transition and transformation, by looking at what we're doing, how we can do things more efficiently. And of course, I think longer term, and Bart, you touched on resilience, which is great, because that's really at the fore here. We can get into a situation now where, learning from our experiences, we can apply those lessons learned and become much, much more resilient as people, and also as businesses, I think, more importantly. And resilience really is a key here for the hydrocarbons business. But what's changing in the world now is really this political discourse and this big move. And previous speakers have eloquently elaborated on the situation from a number of perspectives. And I think when we talk about risk management, I think context is very important. When we talk about hydrocarbons, so oil and gas and coal are all hydrocarbons. And I think looking back at what we did, say 5, 10, 15, 20 years ago, even before that, a lot of the challenges in the business, particularly oil and gas, you look at reserves and how you account for them. That's really where organizations and investors look for value creation and to look at what value, intrinsic value, an organization has and what its stock value is worth. And we had shareholder primacy very much at the front of the agenda. And so that's how everything was measured, and that's how we understood the world. Projects are another big challenge, particularly upstream. Very large capex and typical 10 to 50% overruns as we move to midstream, downstream, always massive overruns. Some of the projects I've worked on over the years, it was always, trying to put risk management approaches into that to try and understand what could happen, how we can be agile and adaptive in how we delivered, using agile approaches to designing, building and commissioning of plants, for example. But capex has always been a big concern, and it will continue to be. And oil price volatility, and as someone mentioned earlier, that there's a lot of capability there now around trading of oil, gas, other commodities. We've got great depths of data that are available. We have advanced models. We have capability of people with the right skills and experience to be able to do that. And I was just thinking back. I think it might have been Dr. Arno was talking a lot more about trading, where a lot of the profits were made for a lot of the organisations, particularly during COVID and just after. Now that we're more in this sort of advanced stage and we're getting getting more adaptive and living with it, a lot of profits have been made out of trading of oil, gas, LNG, and other things. And so we sort of look at the risk profile. It becomes very important to understand how that's going to change in the future. There'll still be a need for traded markets and what have you, but certainly the focus on risk and where we sort of invest the capital and the human capital, the financial capital will somewhat shift, and it will go into other areas, more advanced technologies, which I'll come on to. And we just need to think that when we talk about hydrocarbons, again, 80% of energy production, plus other applications really do rely on the sorts of industries that we're in. And people tend to also forget, and I think it's a theme that's already been echoed this morning so far, is people think about hydrocarbons, they think about oil, they think about cars, they think about planes and ships and everything else. But as I mentioned, there's a big focus here on other areas that impact our everyday lives as well. And so as we sort of go on this great adventure now of changing markets, changing demands, ESG becoming more and more engaged in our businesses, we need to keep all those things in mind and think about what business might look like in the future. But I think just to talk about what's driving the change, and I think I just put one graph here, and I did that for a reason, because I think it's very easy for politicians and policymakers around the world to look at a number and to look at a statistic or look at a forecast or look at something and say, and put a specific interpretation or spin on that. And if we use this, and it's one of many thousands of examples that are out there, we look at it and we say, well, carbon dioxide, we have to do something about it. We need to ramp up and accelerate our efforts to change things. We tend to look at something like this and we start to think what the future might look like. We start to then proactively implement quite major, large-scale change and transformation. And there's one thing, though, to remember, that a lot of these things are built on assumptions. So, and those assumptions can be a forecast, an observed number, a prediction, but also it can be based on something like a year. And 2030, I'll give you that as an example, because many people have already touched on 2030. And I think there's a general consensus around that. We're going to start to see a lot of things coming to fruition in 2030. So we have the UK government, for example, with phasing out sales of new fossil fuel powered vehicles. We see things like, some net zero targets in some places actually coming in the 2030s, coming in relatively early. So the acceleration of the green agenda, the lower carbon economy, net zero, these sorts of things, we sort of look at these curves, we look at a date and we say, aha, we've got a gap. We need to do something, we need to act at various different paces, as many others have said. And Bart, you mentioned there's some of the initiatives of Shell. There was one there on electricity and becoming, I think, the largest or one of the largest electricity players by 2030. And then, of course, other target dates beyond that. And we can look at, I think, a general consensus number of 2050, because that does seem to be the objective for many organisations and governments around the world to actually implement some sort of meaningful change. But there's one thing in this discussion, and I'm glad we're hearing it today, but perhaps we're all just an echo chamber to a large extent. But I don't hear a number of organisations and stakeholders, and especially governments out there, talking about informed risk management and putting a risk management lens on all of these changes and all of this transformation that we're going to see. And I think particularly from an investment angle, again, Arno, Dr. Arno, you said there's a lot of money available for investment out there. There certainly is. But, when you look at the investment angle, ultimately investors expect returns. Now, there are the ESG factors in there, but there are still the hard financial metrics. And what do you predicate any investment on? Is it 10 years, 20 years, 30 years? And I think there's going to be a lot of iteration and agility as we move towards these target dates, 2030, 2050, whatever it might be. And just to sort of walk back a little bit down memory lane, hydrocarbons, I think there's been shifting sentiment. If we really go back, a long, long time, decades ago, I think hydrocarbons, they really were the darlings of investment houses, of stock markets and other things. So investors, banks, and of course, contractors who make their livings out of the hydrocarbon sector. Really relied on hydrocarbons. They were well thought of. It was something that people were happy to invest in. And indeed, many people now who are retired, relied on the investments that pension companies and investments made in organisations such as hydrocarbons companies. And then we sort of came to a point in recent years, a few decades ago, where they were still the darlings of those investors, but we saw funds invest more in them. That they became more engaged in communities in the very early days of CSR prior to the mainstream ESG agenda now, and also sponsoring and doing things with educational institutions. So for quite a while, hydrocarbons businesses, great. But what we see now is there's this whole sort of move towards your new energy diversification and what might it look like, and where are the oil and gas sector in particular, where are they going? So they're going up there, if you look at this sort of chart just as one example, moving up to the top right there. And that's really where investors and other stakeholders are starting to focus their attention now. And we tend to find that in 2021, the hydrocarbons businesses are not liked as much by investors and banks and some funds and even by educational institutions. It's like, that this whole sort of reputational risk around hydrocarbons businesses and oil and everything's bad, I think has become somewhat ingrained in society. And I think there's a lot of false assumptions out there that I think we as an industry need to work towards fixing and I think modernising the thinking. And just to sort of put into context, we talk about large investments. There's the carbon transition alone. At a 2021 figure, I've seen numbers. This one is probably about right, $14 trillion. But with all projects and programs, who knows? It's likely to be at least double that. So ESG mandates, as many people have already alluded to, ESG really is driving this shift. And really, it's looking towards where organisations will go to meet the sort of, particularly in the E and the S part, with the ESG mandates. And that's going to drive the long-term strategy. And it's key for hydrocarbons businesses that want to stay relevant, that want to be profitable, that want to grow and that want to thrive, and want to be seen as a good investment. ESG mandates are very important to that. I think COVID-19 presented an excellent opportunity, and again, its unintended consequences. So there was opportunity there for a number of organisations to restructure their balance sheets and to consider where they're going. So they had this upheaval. We all went through it. We've all lived it to one extent or another, individually or as businesses or as countries. Going through it and saying, okay, time to look at the balance sheet, look at our long-term strategy, look at all the ESG agenda items out there, and move forward with a whole renewed vigour. And it's been mentioned things like carbon capture investments. It's a lot of investment going in there. And this is where hydrocarbons businesses, as an earlier speaker said, you can't really clean up oil and gas and these things. They are by nature that they do have carbon in them. But you can look at how you actually invest in the processes. And there are a lot of processes out there now and more complex processes out there. And, if we look at value creation, which is a big thing in the ESG agenda now, it's really about value creation and sustainable longer term value creation and tapping into the mood, to the opportunities to invest, which actually enables us to access the financing levels we need. And as a natural function, it's very much iterative, actually gives you a better corporate governance rating, which by definition enables you to access more cost competitive funding, green bonds, other things, astute investors that have a real ESG mandate and lived ESG values. And so really the world is our oyster if we take the opportunity perspective in managing the risks associated with what's going on right now. Another thing, and again, it's been touched on already, so oil companies, oil and gas companies and utilities integration. Now, whether that's joint ventures, whether it's partnerships, whether it's diversification strategies, acquisitions, what have you, there's going to be a much bigger play there. And we are already starting to see that in a number of markets around the world. And I think that it also potentially, and this is just a perspective, looking at what's happening in a number of the mandates and looking at the automotive industry as one example, there's potentially areas there for, I think, a bit of out-of-the-box thinking. And will we actually see oil and gas companies in particular having closer alliances, maybe even cross-investments with mining companies, particularly when we look at some of the critical supply chain elements needed there for electrification. So storage batteries for utility usage, for electric vehicle usage and what have you. The big drive towards H2 has already been mentioned, so I won't dwell on that too much. But I was quite amused the other day. Does anyone actually know how many different colours of hydrogen there are out there? Because I was actually quite surprised to learn in a conversation with a colleague of mine that there are about 9. There's even pink hydrogen, and there's red hydrogen, and there's yellow hydrogen, and all sorts of hydrogen. So you can dress them up and shape them and package them any way you want. So I think the marketing people will certainly have a field day with that. But technology gains and really investing in the right technology. But over time, again, 2030, 2040, 2050, I think we'll see shifts in some of the strategies on a smaller scale in a lot of the hydrocarbons businesses and others as they adapt their focus and have agility in their strategy, because some technologies will start to overtake others and what have you. Demand shocks, I think we'll still see non-typical events. So this is another reason why risk management really needs to be at the forefront, and aligning risk and strategy is extremely important because there will be, it may not be a global pandemic, it could be other things. But if we start to look at the upside of things again and the likely beneficiaries of things, well, asset owners, and I think, again, we talk about hydrogen, but things like repurposing and upgrading of some of the assets to handle hydrogen, as well as perhaps bigger demand for LNG. And LNG demand has been growing, but I still think there's a lot more growth to happen there. We saw what happened just last month in the UK, and that old saying we have in the utilities business: when the sun don't shine and the wind don't blow, what do you do? And we've seen it now, not just in the UK, but we've seen it in Texas, we've seen it in South Australia a number of years ago, the UK and other parts of the world, where we sort of look at what's happened in things like electricity generation, transmission and distribution. And we certainly had new challenges spring up there because of the approach to market design. And I think a lot of the risks inherent in energy markets haven't really been properly and fully considered. And I think as we go through these changes, there's going to be, again, risk, but there's going to be a lot of opportunity, upside opportunity to actually leverage that. So I think supply chains are another big area. Again, we put a risk management lens on things, supply chains, and I'm not just talking about, say, decarbonising shipping and that move towards reducing greenhouse gas and carbon emissions and other things in the shipping supply chain, but also I think in the way we ship things or the way we air freight things or the way we get things from point of extraction, production to the final consumer point. I think there's going to be a lot of things happening there. And again, global supply chain weaknesses, that's a massive risk, a downside risk that really hadn't been factored into a lot of organisations' thinking. And COVID-19 illustrated a lot of those vulnerabilities and weaknesses and the need to do something about them. And so I think that... Yeah.
Grant, sorry, but be aware of the time, please.
Sure, okay, right. I'll just move on a bit then. So in terms of managing the risks, I think short-term sustainable practices very much on the agenda and supply chains. And I think also capital constraints, and this comes back to, I think, the slow adapters in the hydrocarbons business, the ones who really don't adapt and grasp the change and invest wisely, will find it much more difficult to access capital. And so I think there'll be opportunity potentially for further consolidation. An earlier speaker mentioned taxation, and one of the big challenges here is there's really no uniform and clear approach to global taxation, particularly on carbon taxes. And I think this will be an area both of downside and upside to be exploited in the future, and it certainly will impact investment. The other big thing is risk culture, and that's going to play a massive role as we realign the risk profile. We look at emerging risks, political and geopolitical risks, technical complexity, and I think we need to look ultimately at how we change our risk culture, because that's going to be important. I know that will be touched on as one of the key themes, as well as ESG in the conference over coming days. And just to leave you with a few thoughts, I was talking to a colleague the other day, and they mentioned a project they did with the UN a few years ago, and they went to Geneva into a big conference room there and had a map of the world on a massive wall and had red pins and blue pins in it. My colleague asked, what are the pins for? And one of the people from the UN said, well, we see that one of the biggest conflicts in the future, it won't be wars and conflicts over oil and gas, it will be over water. And in the whole hydrogen discussion, when I talk to people in a number of parts of the world, they talk about using water to produce hydrogen. But if we take into account the next big scarcity of resource, particularly as we have global population growth, it'll be water scarcity. So again, hydrocarbons will have an even bigger and more important role to play in hydrogen, in clean energy, and in a number of facets going forward as part of a resilient organisation. And so just one final slide. I think risk culture is key, but also the capability, because it's really about the mindsets and the capability of an organisation to execute. So again, we're going to need to adapt people, have the right skill sets, the right mindsets, the right culture to really get things done. But risk management and strategy, I don't think there's ever been a greater time, certainly in my lifetime and my working career, where we've seen strategy, culture and risk management converge to really be the formula for success in the future. So thanks, and sorry if I've run over time, but back over to you.
Thank you, Grant. We have 2 or 3 questions we'll take right now. Maybe this one directly to you, Grant. Since we've been talking about moving from oil and gas, do we expect the same for coal, especially for countries like Australia? And will there be a big lag between the shift from both industries?
Thanks, that's a very good question. So last week, the Australian government made a big announcement on carbon emission targets. But it's been, for those of you who follow Australia and what goes on there, it's been something that's gone on for a number of years now. One reason, obviously, exports. It's such an important export for Australia as a country. It's used right now in steel production. So steel production still does rely on coal. And I showed you the Bowen Basin, that has some of the best coking coal in the world. And really its prime purpose actually is not just power generation. One of the big ones is steel production. I think it will take a while to phase out. But I think along the way, there's going to be a lot of trading off. And I think there's going to be this realization by regulators, legislators, and investors that there has to be a little bit of give and take. And I go back to my earlier point, Australia, okay, we are a developed economy, but I would say I look to Africa and parts of Asia, there's still a lot of things that need to be done to improve quality of life, healthcare, water, education, to actually help grow economies for the better good of people. And I think the E and the S part of the ESG formula, a lot of activists miss this very point. And I think that there has to be, I think, a lot of rethinking of the of people's opinions. I think things are driven by opinion too much. But to answer the question on Australia, I think it's going to take time because you just can't shut it down. Yeah, it doesn't have the financial resources of a 2.5 or $3.5 trillion budget like the US is trying to push through the House of Representatives at the moment. So it will take some time. You can't flick the switch off overnight, particularly on coal.
Okay, thank you. This question for Mr. Cornelson from earlier. Do you agree about the Earth climate passing a different regime through different eras and facing different weather conditions? So not only gases that have been expelled in the air is the only factor for climate change, but the Earth itself has a regime and that is hot, or sometimes we come into a cold era.
Yeah, I want to stress immediately, I am not a climate engineer. I was trained as an industrial engineer, so let's be very. So I find it, I probably can't answer the question, to be very honest, but what I think is important is that the question is based on the premise that climate change isn't happening. And I think, and one of the things that I want to say, and I've been through this debate, particularly in the region over the last few years, is I think we all have to accept that climate change and the energy transition are happening. It's not a debate, it's going to happen. The question is the speed at which it will happen. And that's how, and I think that all the other speakers spoke about that. It's about how do you build that risk, how do you build that resilience into your decision making. And I think the arguing that there's other factors, yes, the world has gone up and down in temperature over time, all the time. But we have clearly, and I think this is one of the things to see, COVID-19 has shown very beautifully the impact that industry has on emissions. If you looked at the Chinese cities when they were in lockdown, the air purified almost in weeks because there was no production. So I think we have to be, and I come myself from the oil and gas industry, the upstream side and the mining side, and I love this business, but I also have to be a realist and think strategically about what do we need to do for the years to come. And I think there were questions around portfolio resilience. I think that's the real important question.
Okay, one last question. Anybody can pick that up. What major actions to be taken to establish portfolio resilience?
Grant, you want to take that? Because I saw you going off.
Okay, I was just going to say diversification, but it needs to be really aligned with risk and a really clear view on risk and aligning the strategy. But from my perspective, anyway, that's my 2 cents worth.
Yeah. I think the addition to that, it's like diversification, yes. So thinking about new business and other things to get into. I think it's also when you look at your current operations, take an extremely focus on cost reduction, a focus on using digital efforts, organizational excellence, organizational efficiency and efforts, looking really at your operations and organization to reduce cost. And I think for a long time, the oil and gas industry has been very good at, like, there was a little crisis, we reduced cost a bit, price went up again. So we kind of gained some fat again. We went up, we went down, but we never really went to the bare bone. And what is interesting is that you see the differences in which, like, for example, private equity funds now look at the way to getting into the oil and gas business, because they don't have the big overheads. They don't have the big technical departments. They are far slimmer in how they run this than we are. And I think there's a lot to learn from that.
Okay, I think we have time for one more question. What could be an effective strategy for saving energy by considering utility consumption in houses and means of transportation used by public?
I think just on the on energy efficiency, if we look at transportation, there's been massive gains made there in technology, whether it's hybrid technology, whether it's more fuel efficient engines. So there's been a lot there. Again, I think some of that needs a mindset change. And again, COVID-19 has been a disruptor. It's people, I said about people getting used to recycling, they're also getting used to public transportation in many parts of the world. People who traditionally, would prefer to get in their car and go somewhere. If they didn't have a bike or other alternative means, go to public transport. COVID-19 came, there's this whole personal risk profile about, oh, this thing's bad. Take precautions. I don't want to go on public transport. I'll get a car. So there's, again, it's a bit of a mindset change. You need to get, how can we get people get that confidence and that trust back so people will go to public transport? That's one way. And of course, in that entire value chain, if it's electrically powered, okay, from renewable sources. In terms of housing, that current situation in the UK now, insulate Britain, people blocking roads and motorways and things. Yeah, this is, now I live in Istanbul these days, and we're seeing a lot of what we call urban regeneration, because there's a reason for that. A lot of the I could turn my camera around and show you actually just in the local area here. there's a lot of new apartment buildings. They knock down buildings that were probably 25, 30 years old, some a little older. Nothing wrong with them, a little bit energy inefficient. And what can you do? Sure, you can clad the outside, and many have done that. But there's one other factor, earthquake. And we're expecting the big one in the next few years. So there's a lot of regeneration driven by that. So that just happens to be fortunate that with that comes better insulated buildings that are more energy efficient. But in places like the UK, you have a lot of high density living in major cities, and the buildings are very old. Now, they're not prone to earthquakes or other things. So what do? You can't just really go and knock them all down and put new builds in with better energy efficiency. So I think it's really a big challenge there. The UK government has already talked about phasing out gas-powered boilers and moving to electric. But okay, again, that will need the entire system to be rethought. And it's not just the UK, by the way. I'm not picking on my because I lived in the UK a number of years. I'm not just picking on my friends and people there in the UK, but a number of other countries as well need to think about their electricity markets, how they're designed and what the energy mix is. Because a lot of them have raced off to go to all the renewable green stuff. That's great. But again, as I said, the sun don't shine and the wind don't blow. What are you going to do? So there's a lot of thinking still to happen there in terms of efficiency, with buildings and housing, for example. So that's still going to be a big challenge in a number of parts of the world. And even switching from gas to electric is going to be a massive cost burden on people, on individuals who can't afford it. So again, we have that S in the ESG part of it, that social part of it. How do we actually not disadvantage people or groups of people in doing that? So it's a big challenge.
Thank you. We have 5 minutes break for just whatever, especially the moderator needs to take 5 minutes break, and we will move on to the next session in 5 minutes. So by the way, we have almost 600 viewers. So this is very, very good sign for this conference. So we'll see you in 5 minutes. Stay online.
Thank you very much.
The world, and will focus on how ERM can add organizational value in the post-COVID era, as well as discussing a range of key industry challenges and opportunities, with 2 days of online strategic and technical sessions with over 20 experts speaking. Be part of this valuable event. Book your place now at KuwaitERM.com.
This conference aims to bring together risk experts to discuss key emerging issues in the area of enterprise risk management.
For the 6th consecutive year, Kuwait Petroleum Corporation and its subsidiaries are organizing the Enterprise Risk Management Conference. The conference will be held virtually for the first time ever, and the slogan of this year's conference is COVID-19, a strong business case for ERM. As the world adjusts to the new normal, the oil and gas industry is also changing to define a new vision for its future. This year, the conference will bring together participants from across the world and will focus on how ERM can add organizational value in the post-COVID era, as well as discussing a range of key industry challenges and opportunities, with 2 days of online strategic and technical sessions with over 20 experts speaking. Be part of this valuable event. Book your place now at KuwaitERM.com.
This conference aims to bring together risk experts to discuss key emerging issues in the area of enterprise risk management.
For the sixth consecutive year, Kuwait Petroleum Corporation and its subsidiaries are organizing the Enterprise Risk Management Conference. The conference will be held virtually for the first time ever, and the slogan of this year's conference is COVID-19, a strong business case for ERM. As the world adjusts to the new normal, the oil and gas industry is also changing to define a new vision for its future. This year, the conference will bring together participants from across the world and will focus on how ERM can add organizational value in the post-COVID era, as well as discussing a range of key industry challenges and opportunities. With 2 days of online strategic and technical sessions with over 20 experts speaking, be part of this valuable event. Book your place now at kuwaiterm.com.
Hello? Hello? And we are back. Our next session, COVID-19. December 31st, the first case, arguably the first case was discovered. March 11th, 2020, pandemic was declared. Over 236 million cases confirmed, and we know the number is larger than that. Almost 5 million lives lost. Almost 2 years later, we're still fighting pandemic. The question is, could we have done a better job managing this? Is there a long-term effect of the COVID-19 pandemic? And what did we learn from this? Our first speaker is Michael Santoli. He's a principal, the principal and ERM practice leader with ICA Risk Management Consultant, an independent risk management consultancy firm founded in 1956, I guess before we were all born. He provides consulting services to the firm clients in diverse industries. In 2011, he established and managed the ICA United States West Coast office in Newport Beach, California, where he services largest West Coast and Asian clientele, providing risk assessment, management, and audit, as well as enterprise risk management services. Michael, the mic is yours. Hello? Should we move on to the next one?
No, he's coming. He's coming, Masood.
Oh, okay. I see him now. Michael with us? Michael, maybe your mic is on mute, although it doesn't show that. Michael will be joining us any second. Let's consider this a partial lockdown till he joins us. This is what happens when you live in a nice place like Newport, California.
I think, Abdulaziz, I think one of the interesting questions that I would like Mr. Grant Griffin to answer is, it was one of the questions that has been raised by one of the participants about, the water scarcity, especially in GCC. As you know, that we are greatly dependent, on desalination. And, we would like to know, how would that water scarcity be affecting the GCC countries?
Yeah, that's a great question. I wish I had answers, but I don't know. Look, if you believe that polar ice caps are melting and water levels are rising around the world, then we're going to have a lot more water, aren't we? I mean, we can take that sort of view of things, but the realities are, I know what you mean. It's really about drinkable water that can be used for human sustenance as well as agriculture and everything else. I think what needs to happen, I think there will be a rebalancing in a lot of this, and we are already seeing a number of, interest groups and others calling out things like the fashion industry or the textile industry, because the amount of water that is needed to produce, say, a pair of jeans, and I think we've all heard those sorts of statistics. So what can we actually do to become more water efficient? But the challenge is then, as you say, for the GCC region, how do you actually address that specific problem? Now, it might be that some of the investment and some of the supply chain shifts are going to be around getting more clean water to locations like the GCC. So the next big trade, perhaps, and this has been spoken about for a number of years now, will be in water. So perhaps we're going to see things like water facilities at ports and quite large tankers for water, much more investment happening in those sorts of areas, for example. And that may be something that some parts of the world may have to just rely on as an import, whereas some other parts of the world rely on oil or gas for imports or agricultural products for import. So I really don't know what the answer is and what the future holds, unfortunately. I wish I did. If I did know for sure, I'd probably be a billionaire because I could solve
it. Thank you, Grant. Michael is still having some difficulties, so we will move on to our next speaker, Dr. Mohammed Saidan. He received his Doctor of Science degree from the Epidemiology and Environmental Health Department of Harvard. He's the head of the Environmental Health Division, as well as the lead epidemiologist of the COVID-19 response in Kuwait's Ministry of Health. Has been involved in environmental exposure and health research, as well as policy development in the Kuwaiti society. Doctor, microphone is yours.
Bismillahirrahmanirrahim. Good morning. I hope my voice is clear.
Yes, it is.
Okay. So let me share my slides. There we go. Thank you very much for inviting me to be part of this very interesting conference. And I'll be, sorry, I apologize, I'm in the way. Just give me a second. Here we go. Can you see my slides?
Yes.
Okay. Excellent. So I'm Dr. Mohammed Saidan. I'm a public health specialist, and thank you for introducing me. Today I'll be speaking about the risk assessment and management in the COVID-19 pandemic. And the reason why we want to talk about this is that we've been through a very rough couple of years, and such risks usually are not confined to just one sector. And it helps a lot to understand what's going on in the health sector, especially that, and we've seen the past couple of years, all these risks tend to spill into other sectors, whatever they are. If they're the oil and gas, the society, the economy, and such. So this will give you sort of an insider view of how decisions are usually made in the public health sector. And of course, we've done a lot of work over the past couple of years. So it's going to be very difficult to have them in 20 minutes. But I'll do my best to give you a general idea. So let's start with the definition of risk assessment. So according to the World Health Organization, risk assessment is a systematic process of gathering, assessing, and documenting information to assess and assign a level of risk for any issue, and it provides the basis of action to manage and reduce negative consequences of acute public health risks. Risk assessment is not a foreign idea for different sectors, and the general principle is very similar between sectors and different disciplines. And even within disciplines, the methods of risk assessment can vary slightly. For example, here in chemical and physical exposures, usually you start with identifying the exposure, whichever it is, and then trying to identify if there is a dose-response relationship in terms of how much of the chemical causes how much disease. Does it cause 1% illness? Does it cause 50% illness or so? And then identifying the exposure, which is really important to know, especially in identifying who's at risk and how much is everyone exposed, and then you characterize the level of risk. When it comes to infectious disease, things are slightly different because it's not as straightforward, because you have the agent that causes the illness, the organism, and then you have the exposure and the context in which all of this happens. So this makes it a little bit more complicated because they're sort of intertwined when you're trying to identify the risk that you're talking about. So let's talk about COVID-19 here. We've identified that the agent is the SARS coronavirus 2, which is an illness that causes respiratory disease. So we go through the hazard identification by asking what kind of disease does it cause and how severe is this disease, and then is there any antiviral or treatment that is effective in reducing the severity? And now that once you know all of these questions, you want to know if there's sustained human-to-human transmission, which would tell you more about how things are going to progress. And finally, if there is human-to-human transmission, how fast is it? Let's look at what information we had at the beginning of the pandemic. We received some reports from China about a new coronavirus that is spreading, and there's some warning about hospitals. Early data or early information showed that there were very few cases. So for example, here, there were like around 41 cases of pneumonia, of which only one person had died. And then since then, there haven't been any more cases or deaths in Wuhan. And then the sustained human-to-human transmission situation was not really clear. So at that time, we didn't really have enough information to characterize this as a huge risk. So moving on, 2 weeks later, we have 1,400 cases. And then we have about 130 people that have died because of the illness in China. And then from Wuhan, you see that there is this huge spread through China only in 2 weeks. So this really puts us into the category that this virus is actually a risk for Kuwait for different reasons. It shows that there is sustained transmission. There is high risk of mortality, and it is spreading over over China. So in such a short period, that means that it's going to spread to different areas in the world, and it could be imported to Kuwait. So this brings us to the other part of the risk assessment, which is exposure and the context. So who would be susceptible? We need to know that. What is the incubation period to know how long is it going to take for the virus to be transmitted to one person or another, and thus exposure, and when is the person infective during that? Is it during the incubation period, or is it when symptoms appear? And what is expected risk to the population as a whole? And finally, what is the likelihood of importation? So these are some of the questions that you try to look at when you're trying to identify the risk of exposure and the context in which this could happen. When we went back, I'm saying we went back, but at the time it was real-time information coming in. Early estimates showed that there was an 18% case fatality rate, which means that for every 100 persons that have been infected, 18 died. But then those were revised as more and more data came in, and it was revised to about 1.3% case fatality on average. And then we identified the age groups that were at higher risk. So now, among those who are 6 years or older, the risk was about 6.6%. Among those who are 8 years or older, the risk was 13.4%. The incubation period was 14 days, which is very long for an infectious agent like this. And transmission occurred during that incubation period, a few days when the person was asymptomatic. We saw in China, they were building this 1,000 bed hospital within 10 days, which is huge. And it really means that there is a huge population risk. So to answer the question that we have, the whole population is at risk of infection. We know that in terms of susceptibility to mortality, older age groups are at very high risk. Importation is very likely because of the length of the incubation period and because transmission is occurring before symptoms appear. And this brings us to this classic cycle of decision-making and planning. So, the typical plan basically goes through several phases. You put the plan based on what you need, you implement it, and then you collect data, and you evaluate the current situation, and then you revise the plan, and so on and so forth. In terms of the pandemic, we had three main plans. So the first, or three main aspects of the plan. The first one is to contain or prevent importation of the illness. And if that fails, we needed to delay or suppress transmission. And if that failed, we need to protect the healthcare system until we're able to reach that final goal, which is either finding a vaccine or treatment. So when we do this plan, the final endpoint of this plan is to reduce mortality and long-term disability. So when we translate this into terms of pandemics and health, we look at the WHO model for epidemics, and basically it divides the epidemics into different levels. The first one is the level of no local cases, and that the prevention in this area is to prevent case importation. And then the next level is sporadic cases, when you have some cases here and there, and the plan then shifts to prevention of case transmission, which is basically contact tracing, isolation, and quarantining those who have been exposed. The next level becomes clusters in some areas where you have groups instead of individuals, and then you try to prevent the spread from those clusters or certain areas to the rest of the country, and that might take more severe or significant interventions, such as area lockdowns, and what we've seen in many areas in the world, such as Wuhan, and even in Kuwait. And then the last stage, which is the worst stage of the pandemic, is sustained community transmission, where everyone is getting infected without identifying a source. So for us to put a successful plan, you need several elements, and especially a plan that is on such a large scale or on a national level. You definitely need multi-sectoral involvement and coordination. You definitely need to have team preparation on from different sectors that are working together. You need to have appropriate communication channels. Otherwise, if you don't have the communication channels, things are going to start falling apart because things are not going to be harmonized. And then, of course, funding and logistics support is essential. So having all of these, you still need to have your plan in writing. You need to have your flow charts, and you need to have like a summary of your work plan. So this is an example here of the flow charts that we used in some of our work. And this is basically the triage of people coming in and how they're going to be triaged into home quarantine, facility quarantine, or hospital quarantine. And then, of course, it is extremely essential to have all the manuals and operational policies written down, because the summary work plans are not going to have all the details for every person to understand, and these can be important references, and they have to be updated every now and then with new information. So let's look at this part that concerns the early part of the pandemic, and this is where we were focusing on preventing or delaying importation of cases. So part of the plan included suspension of travel from areas with high risk, implementation of institutional quarantines of repatriated travelers, and implementation of active surveillance and testing of incoming travelers. So these, of course, have some caveats, but I'm going to talk about them in the next slide. The action objectives is to either reduce or prevent transmission of cases in the no local cases situation, where you don't have any cases and then you don't want any more cases coming in. If you have, and to prevent high load of cases that are coming in from travelers, and then prevent importation of problematic strains, such as the new variants that have been causing problems all over the world, and the latest one is the Delta variant. And this plan works in either early stage of the pandemic, where you have no local cases because none have been imported, or in tightly controlled transmission communities and countries. And an excellent example was Australia and New Zealand for most of this pandemic, where they have had very tight traveler control and testing and isolation. So this is the part where we worked on suspension of travel. Of course, suspending travel has its implications, whether it's economic or societal implications. And we had to match the level of risk with the intervention. Otherwise, we were either going to overshoot or undershoot our targets. So at the beginning, when the disease was confined to China, we suspended travel to China. And then when the list of countries where the virus has been spreading to increased, we also expanded the list of travel until it became apparent that a lot of countries already are getting infected, and that's when we suspended all travel. And this is an example of taking a decision and weighing the benefits and the costs when you have incomplete information and uncertainty. While maybe suspending all travel from the beginning could have helped delay case importation further, it could have had a lot of negative impacts. So this is where the decision-making comes in such situations. And the next level, we had the transmission control And this is when we already have imported some of the cases into Kuwait. And the three main pillars of the transmission control is testing and identifying cases, isolating the cases and quarantining contacts, and implementing social distancing. And of course, like any plan, it has to be submitted into continuous monitoring and evaluation. So the government had to look into all the available tools in the first phase of the pandemic, where there is no treatment or vaccine available, and we had to enumerate them and try to understand how to use them. So and we had the non-pharmaceutical interventions, and they included, of course, we started with the risk communication and awareness campaigns, because your partners here are the community and you need them to cooperate with you. And then you have mobility reduction and social mixing reduction. And these are important in cases of pandemics such as the COVID-19 pandemic, where you need to reduce the transmission chains. And of course, these come with the suspension of unnecessary activities, which may increase these mixings, and mandatory quarantine and isolation. When things become really difficult and your healthcare system is at risk, you can move on to more stringent activities, such as the partial lockdowns or even full lockdowns. And the reason why we have this kind of extreme measure is to protect the healthcare system capacity. So you have a capacity that can take a certain number of cases over a time period, and you don't want to exceed that. So for example, under normal circumstances, when everyone has healthcare, you could have like maybe 1.5% mortality. But then if you exceed the healthcare system capacity, then you will be looking at multiple folds of mortality. So instead of losing 1%, you're going to lose 6 or 7 or 8%, just because you're not getting the basic healthcare needs. And this is why it's been measured. So when we have all these plans and ideas, and we know that these plans can be helpful, and we write them down and prepare them, you think you're going to be successful. And you think it's straightforward. Unfortunately, that is not the case with complex situations where the community is involved. You have different sectors that are coming in. You have your risk management plans that usually clash with your reality. And you have to deal with all of these challenges that you're working through. You have the cultural norms and barriers, because again, you're not working with a machine, you're working with a community, you're working with cultures, you're working with people, and there are different barriers. When you have something that happens suddenly like this, you have to have the infrastructure that you need. You need the manpower, for example, for testing. You need to know how to isolate, you need to monitor the situation, monitor the cases. And then you have the underlying living conditions. And you have people's risk perception and compliance. So in reality, you have a culture that is very, very social, and it becomes very difficult for somebody to come in one day and say, okay, you can't gather anymore. And then you have living conditions where, you try to implement social distancing to decrease the transmission risk. And you have people that are unable to do that because their living conditions does not allow them. And then, of course, you have people that need to deal with their daily necessities. If you say to everybody, you have to stay at home, never leave, don't do anything, but you don't have the infrastructure to make that happen, then they have to leave their homes to get their daily, what they need from the markets, what they need for their daily living necessities. Of course, in the beginning of the pandemic, we had other logistic issues. The world was very short on testing, and that caused difficulties in identifying cases and isolating them. Risk perception is another burden and another issue. If you tell people, you need to take all of the precautions. They, if they don't perceive the risk as really there, then they're not really going to comply. And then, of course, you have misunderstanding and lack of compliance. You have fake news. You have a lot of people, you tell them about social distancing and wearing masks, but then they misunderstand it, and you get something like what you have here in the picture. So the result was that the initial spread was in lower socioeconomic areas in worker homes, where most of these challenges were there. And when you see down here in the blue sector, or the blue side of the chart, you can see that the first wave in Kuwait happened among non-Kuwaitis and the worker population, and then later on it spread to but because of the interventions that were there, the transmission has plateaued and over this whole period. And then when we went into the winter outdoor season, things started to calm down. The result also was that with all of the interventions that were done, we've had relative success. We never exceeded the healthcare capacity over this whole period, which is a great thing. It means that almost everyone that needed healthcare was able to get it. This does not come without the downside. Of course, you have a huge economic loss. You have a lot of mental and social strain. People have suffered through this pandemic. A lot of livelihoods have been affected, and even education and development in children and young adults has taken a hit. So this is why it's not really straightforward. It becomes really a balancing act. You have your epidemic situation and the risks from the epidemic, and then you have to weigh it against all the interventions that you have to do to prevent these risks and to balance it out. And then you have to remember that people don't really make rational decisions, and this is a bias found in all of us. And this is an issue with risk perception. So if you look, for example, here, this is about one of the interventions, which is the most effective intervention in this pandemic, and it's vaccination. If you look at the risk of mortality, death due to vaccination in Kuwait, it has been like 0 per 100,000 so far, thank God. And then when you look at the risk of death due to COVID, you find that it's about 57 per 100,000. And the risk ratio, when you compare them, is like infinity. Yet, you have an issue with risk perception. You have people don't want to vaccinate because they perceive the risk of vaccine to be much higher than the actual infection. And there are different factors that affect this perception. So for example, you have people with risk of change, people with risk of the unknown, the possibility of regret. If they do something they don't want to regret, if something was framed to them in a negative way, they could take the wrong decision, even though it is the same problem. People usually are okay with the status quo. I'm at home, I'm not sick, nothing happened to me, I'm happy with what I'm doing, why should I go get vaccinated? And then you have something that's based on probabilities, while the general public does not understand probabilities. If you tell somebody you have a 10% probability of dying, then they'll think it's a probability, not a certainty, and they see what they have at the moment as a certainty. And then you have recency bias, where people look at their friends and say, "Oh, I know so and so and so. All of them got affected. It's like the flu. Nothing happened to them," but they don't understand, or they don't see any other examples. Here's another example of risk perception, decision making, and framing. You have a person here that has the slide that says, or I don't know, like the sign that says 99% of COVID people recover. But this actually, that 1% is really huge. But anyway, if you really frame these questions in the right way, more and more people are now going to think that way. So for example, if you ask somebody, what would you need to get paid to get infected by a virus that has a 1% chance of killing you? They're going to react and respond very differently than a person that gets the question of how much would you pay for a vaccine that can help prevent a 1% chance of death when you already get infected? So people really perceive risk in a different way depending on framing. And then, of course, given that we have the best intervention that we have, we still need to balance how hard to push the vaccine on communities. You have the necessity of returning back to education in a safe way, and the safest way is to having people vaccinated. Returning to social functioning in a safe way, returning and reducing overall mortality with vaccination. We can't have people dying day in and day out because they're not vaccinated. But on the other hand, you have to balance it with the social liberties and the work liberties. How hard can you push for mandatory vaccination in communities to be able to reduce these risks? And different countries have had different approaches. In general, we have some take-home messages. We need to invest more in emergency preparedness, and that can reduce the hurdles that we see and the challenges. It's important to invest in better living conditions that enable people to cope and reduce the risk of death and mortality. And of course, it goes without saying, investing in healthcare infrastructure. Finally, challenges are not always, well, challenges are always a negative thing when you deal with them. But then we really need to look at them as an opportunity to learn and improve. And here are some examples. For example, we significantly improved our lab capacities. We have learned, we've created systems that have learned to digitize the data collection and analytics that we have. And this could be a very important step forward for us as a country to move different sectors into the digital world and take advantage of it. So we should not let any challenge go without learning from it. And as Winston Churchill said, failing to plan is really planning to fail. Thank you very much.
Thank you, Doctor. Are you going to stick around because we have questions at the end of the session, or are you going to be leaving us?
I'll be around.
Okay, thank you very much. Good news, Mr. Michael was just released from his quarantine and he can join us. Michael, you there? We see you, but we can't hear you. We still can't hear you, Michael. You unmute your, shows that you're still muted, Michael. الو هذا شايف اوكي يقول له قاعد يسولف هو اوكي يلا looks like Michael is still in quarantine, so we will move on to our next speaker, Mr. Shoaib. Shoaib is the team leader of health, safety and environment at Kuwait Gulf Oil Company. He played a major role in managing COVID risk here at KGOC. And if you're starting a basketball team, he can be pretty darn good power forward. Shoaib, the floor is yours.
Hello, Masoud. Thank you so much. Just a test. Do you hear me well?
You look good and we hear you very well.
Thank you very much. Should I post the presentation from my end?
Victor?
Yes, Shoaib. Yes, it's yours.
Yeah.
You share the screen now.
Okay, is it clear to everyone?
Yes, it is.
Yes. First of all, thank you, Bousroud, and I'd like to thank the conference committee to honestly make sure that all the challenges have been overcome. And this conference has happened even through the pandemic. Well, inshallah, by next year, we'll be able to meet all of you in person and this pandemic will be over. Today, we'll go through a little introduction and a short video about the COVID-19 pandemic, since we're talking about utilizing the technology during the COVID-19 period. We'll go through some of the systems we've utilized at KGOC, the risk list, and the lesson learned during COVID. I'd like to share a video.
Scientists made multiple vaccines in less than a year, but a handful of countries grabbed virtually all the supply. Companies have not shared their recipes and technology. And while a small number of companies have made billions, there's not enough supply to go around. Every day, 10,000 people are dying. Fast-moving variants threaten to undermine progress. It's bad for health, it's bad for business. We can end this pandemic. There is hope. Some countries have started sharing doses. New manufacturing hubs are being built. Sharing of know-how and technology is beginning, and the majority of the world now backs a temporary waiver of intellectual property to help boost vaccine production. We are in a race against time to beat the virus, and we must all do more, faster. We can produce and deliver doses to vaccinate 70% of every country by the middle of 2022, including those in the hardest to reach places. No one is safe until we're all safe. It always seems impossible until it's done.
So again, the vaccine decision, we see it at KGOC. It's a personal decision, but to be honest, we try our best to promote it around in our workplaces since it's available, it's free. There is an access to it in our countries, so we still hope that we try to cover as many employees as possible. COVID-19 pandemic has accelerated the digitization and transformed business forever. And yes, to be honest, earlier last year when the pandemic hits, we thought it's going to take 2 or 3 weeks to get it over with, to be honest. But by April, we started seeing things differently at KGOC. It started to hit us that the pandemic could last a year or 2 or maybe more. So the crisis management team at KGOC started to form sub-teams. One of the teams was in charge of the current situation and how to help the company stay efficient, how to help the production areas stay safe and produce at the same rate, and also how to think of utilizing technology and make it part of KGOC culture in the long term. This picture was honestly the basis of how the company were thinking. Early in the pandemic, we all know Legos. We all know how Lego starts in a mess. And this is what happened early in the pandemic. No one was exposed to such pandemic. So when we start thinking and brainstorming throughout 2020, maybe around the second quarter of 2020, we started to arrange our thoughts, visualize, so the foundation that we have at KGOC, and try to increase the level of the technology we have and utilize it into the best of our company. So around June, end of June, when the government allowed us to return back to work, we were lucky that we do have the foundation and what it takes to face such pandemic in terms of technology-wise. Every employee had to fill an online self-assessment, which is also in line with the WHO regulation. And most of our systems in KGOC were also aligned with the rules and regulations of the country in Kuwait at that time. So we started with the self-assessment for each employee. This was done on weekly basis. If we remember back in June 2020, we were only allowed to have 30% of the workforce to return to work. So those 30% were used to filling these forms online and make sure they don't show up to work unless they're feeling well. The second system that's, to be honest, used today as we speak is the online appointment system. We all know that the K company environment has a lot of visitors, has a lot of contractors that would like to have inquiries. And, you know, we weren't used to the non-face-to-face meetings. We weren't used to phone calls and stuff. So this system allowed us to have these online meetings that, to be honest, spread everywhere in the country. And upon that system, we still use the system. And the online meeting is directly connected to all of our gates at KGOC. So whoever submit their meeting, their appointment, we could see it at the door and we let that person in. And to be honest, the most interesting and developed dashboard is the one you're seeing on your left side. The COVID-19 dashboard was inspired by the live WHO dashboard that we were noticing back in 2020. We felt the urge at KGOC to see our cases in production areas, since we have 3 locations: Ahmedi location, which is the head office, we have Wafra location, and Khafji location. So we provided a dashboard that's friendly and easy to use for the upper management to view the cases live day by day. So if you can see on this box, we can see the new cases, the new recoveries, the new deaths, any direct contact cases. And when you click on any of these boxes, you can actually see which area is more affected than the other area and how we can mitigate or have a backup plan for that area as well. We can, on that box, we can see whether the infected percentage is KGOC employees or non-KGOC employees, which we call the contractor at the operational area. The bottom box also shows us how the cases at our company are increasing throughout the time. And to be honest, this little box here is also interesting. It helped us a lot in knowing where the problems are. So it's called the hazard reporting graph. We have a hazard reporting system that you will see later on in this presentation, where every employee, if they see a social distance issue, if they see any issue that's related to COVID-19, they can just report it immediately and we can take actions. We can amend our awareness plan as well. It also shows us how many online meetings we're having in the company on weekly basis. And the most developed part lately is this part, which is the vaccine part. It also shows how many employees are vaccinated, and these percentages, to be honest, are not up to date, but it feeds from every user of the company. So if you log in, and later on you'll see the system where you can just log in your vaccine data, whether you're vaccinated once, twice, or not vaccinated, or do not want to participate, which we said earlier, we don't hold anyone accountable for their vaccination decision, but we'd like to know for our own sake. So it's a complete dashboard, and what made it easier is that we had the infrastructure. We had the infrastructure at the company that helped us develop the system at KGOC. So this survey is, once you click on it, it's connected to your personal user at the company and feeds directly to these percentages here at the dashboard. This is another interesting system that was heavily used at that time. And to be honest, this is one of the systems that we're not using anymore. And it's directly related to the percentage of employees allowed within the company. As we all know, the workforce in Kuwait during COVID, it was restricted with a percentage. Like we started at 30% of the workforce to show up to work to make sure everyone stays safe at home. So we created this to know what is the percentage or who is going to show up at work during that period, whether it's 30% or when it went up to 60% as well. So this automated system, it allows every team leader to enter the employees, or we call them the group A and group B, since they alternate every week. And it shows us the percentage of the allowed people or employees coming to work this week, and the ones working from home, and the ones who are also might be affected as well. And again, all of these systems you're seeing are directly connected to the user. So it's very user-friendly. So this percentage feeds off to the group percentage and the KGOC overall percentage as well. So this is another dashboard. It's called Building Occupancy Dashboard, which is also very helpful in trying to chase the cases and assuring that our buildings at KGOC were very secluded, let's say. The earlier dashboard, this dashboard shows us the percentage of people that's allowed to come. And this dashboard shows us exactly how many we have at each of the buildings. We have up to 7 buildings in KGOC, which was a positive thing for us to have so many buildings during the pandemic. So every building was working at their own. So if we see a case, let's say in one of the buildings in building 1, we could easily seclude that building, control the people coming in and out, and all of these tracing system, we can identify it through the security entering and leaving the building, and whoever entered the building, we could easily trace it and isolate them from coming to work and have the next group showing up the next day. And this little form is called the observation audit form. As you can see in the top right, it's a little barcode where you can just scan it and go directly to the form. And if you see any COVID-19 related observation you want to report it, just click, select the location, put your comments, and it will come directly to the person in charge, and they'll take immediate action on it. That's the weekly summary report of COVID-19. We've created in KGOC a group representative SME, which is a special the SME for each group was in charge of controlling or knowing where the cases are within their group and reporting it immediately to the HSE and the COVID-19 pandemic team. And the SMEs were trained very well to fill in these details on a weekly basis, and the SME can fill that form through their mobile as well. And during the pandemic, to be honest, we've started adding the pandemic risk to the company risk, and utilize all the lesson learned during the pandemic into that risk. What we've learned during the pandemic, to be honest, I've listed the systems down that we've utilized or developed during the pandemic, and which ones we're carrying on and using up to this date and maybe after the pandemic as well. But the most important lesson we've learned is we have to stay ready. We've seen the difference between the organizations that had the infrastructure ready for any future surprises, pandemic whatsoever, and the ones that weren't ready and working manually. We've seen the speed, we've seen the pace that we work on, we've seen the efficiency. It's totally different. So the most important lesson for us is to stay ready, be ready. You never know what's coming up for us. So we do have a great IT support system. The upper management was very focused on developing our IT. So that helped us a lot, developing all these systems during the pandemic, controlling the cases, controlling the tracing of the cases. And that just, to be honest, we're part of a society. And if we can control our own bubble, we can control at least the people around us, the people at our houses and our family and loved ones. So again, this is it for me. Thank you all for listening. And if you have any questions, the floor is yours.
Thank you, Shaib. Hope to see you back in Kuwait soon.
Thank you, Basood.
Michael, are you out of your quarantine?
I believe so. If you can hear me clearly.
Yes, we hear you. The floor is yours.
Thank you. And we appreciate your patience, and we apologize for the technical difficulties. First of all, I would love to thank the organizers and the participants for inviting us to address you today. My name is Michael Santulli. I'm a principal and ERM practice leader at ICA Risk Management Consultants. We're based in the United States, both on the East Coast, and where I'm joining you from the West Coast in Newport Beach, California. What we're going to be talking about today and what I'll be addressing is somewhat similar to, and I'm sharing my screen now, to what some of the other presenters mentioned, and also will mirror some of the aspects of risk culture, which I know are going to be brought up tomorrow in much greater depth. But what we're going to be discussing today is a trend that we've been seeing, not just globally, in essentially the data that is coming to light, but also what we've been seeing with our own client base. Our client base, both here in the Americas, as well as in Asia and in Europe, and in the Middle East and parts of Africa as well. And that is the pandemic and its effect on human capital and what that really means for businesses and companies. So what we've been seeing in terms of a global trend is what's being referred to in many circles as the big quit or the great resignation. And what this is a large number of workers across the board in all industries and at all levels beginning to reconsider their career decisions for various reasons. Recently, a Microsoft survey indicated that about 300,000 or 30,000 global workers showed, when they were surveyed, showed that about 41% of them considered quitting or changing their professions just in 2021. Workers in the UK and Ireland, as well as workers in the US from US Department of Labor Statistics, indicated that they would be reconsidering their positions. And in part, we're seeing this because of either access to a workplace and the ability or the lack of ability to work remotely, fear or concern about contagion with the COVID-19 virus, as well as some of the things that have been mentioned before in terms of vaccine apprehension, as well as other more existential issues that have been facing the workforce, which are a little bit harder to pin down, but just as significant. So in a recent survey with different employment organizations, they found that up from 35% in 2020, about 52% of all respondents, which is a significant increase, indicated that the work-life balance as well as compensation were two of the main motivators that were affecting people's decisions or workers' decisions to either stay in their positions or potentially move on. And that a good majority of workers in 2021 would be considering looking for alternative positions. There are also a great deal more options open to workers now because of the advent of hybrid or remote workplaces, which means that their talents can be recruited from other, maybe not geographically proximate locations to where they live or where they have previously worked, which means that global workforces now are much more fluid, and it affects the ability of companies to retain and motivate their human capital or their workforce. There was a recent study done by Mercer, which is a subsidiary of Marsh, where risk managers and professionals were surveyed and asked about what are the top risks that they're seeing or elevating in their organizations. And 3 of the main top risks of the top 10 that were surveyed related directly to human capital. Issues of talent attraction, retention and engagement, succession and key person risk or succession planning, as well as conduct and corporate culture. Corporate culture is something I'll touch on a little bit later as well. What a lot of companies are expressing, though, is that they feel very vulnerable with respect to their position surrounding people and talent inside the organization. I will tell you that our own experience as a firm with the clients that we have just this week and earlier this month when we've been updating for Q4 2021, a lot of our working with our clients on their ERM systems, what we are finding across the board is that whether they're in Jakarta or Japan or North America, or whether they're in Europe or someplace in the Middle East or sub-Saharan Africa, we're finding that in all of our clients' top 10 risks or issues that they are most concerned about, retention, key planning and succession planning, as well as any type of culture or talent issues are key things that they are all concerned about, reflecting the data that we're seeing out there that is also public, such as this from Marsh. Observations, effects, outcomes. Information shows us that on average, an employee, a key employee, leaving a company will generally cost the company about 33% of their annual salary in terms of investment, training, and having to retool for those positions. The cost of replacing a highly trained worker or employee, especially in industries that demand that, can be up to about 200% of their annual salary. which is significant from an investment standpoint for an organization. Millennials, from a generational standpoint, are expected, about 31% of them, are expected to leave their job within 2 years, which is not atypical of what we see of workers in that particular generation, where they feel as if they need to have or desire more job mobility, but it also is more difficult to engender new talent and bring it throughout the organization based upon these types of trends, especially within that generation. Statistic based in the US, by 2030, it's anticipated that low talent retention will cost companies about $430 billion annually, which just really emphasizes or brings home the fact that human capital and talent is a very significant commodity internally for many companies, and attention must be paid to retention and training and the ability to understand what their needs are. High retention rates can also, on the other end of the spectrum, increase a company's profit up to about 4 times, depending upon the industry you're in. And even if that multiple isn't something that directly applies to a particular industry, it is widely accepted that retention does increase exponentially the efficiency of most organizations. Companies are fighting for talent to attract it and keep it, which many economists actually believe is is a sign of a strong economy, quite frankly. However, it also presents challenges. 48% of companies will change processes to become less dependent upon institutional knowledge. And this is a really key point. If organizations, and we find this with our clients as well, have key information vested in individuals and not in the institution or the organization, they're placing themselves at particular risk when scenarios like this come to play and when turnover increases because of larger global influences. Turnover and any type of employee retention can be influenced by many things: retirement ages, changes in local or national regulations having to do with pensions, could be life choices or health issues. The COVID pandemic has just placed an added pressure and also added another layer to many of the existing issues that were already there. In response to that, many companies who are experiencing or have the ability to effectuate a remote work environment actually see about 25% less turnover in their employees. But that in and of itself creates other problems. And one of the main problems that tends to create is an erosion of corporate culture because of the hybrid workplace. And corporate culture is also key to being able to mentor and bring along new talent and also retain talent internally, because many employees, when looking at satisfaction surveys, one of the main things that they actually cite is corporate culture as one of the reasons why they stay with many organizations. And a hybrid workplace does not necessarily allow for those softer, more subjective factors to take hold in a corporate culture. All right, what are we seeing from our perspective? What are a lot of the clients we service? What they're doing now is they're actually using their ERM programs as a tool to better identify both some of the issues and the risks associated with this, some of the causal factors, and better try to identify and flesh out control measures, both preventative and from a mitigating standpoint, to help affect positively some of these changes that they see happening. Some of the questions that are being asked are, how can we retain needed expertise, skills, and capabilities? Retention of leadership is key. Okay, key members of leadership, if they're exiting the company, when they exit companies, they can take with them a great deal of institutional knowledge, as well as they can take with them people who reported directly to them, who might have loyalty to them and might be part of their team. And therefore, you're not just losing an individual, you potentially are losing an entire team, that institutional knowledge, and that functional ability. Retention in corporate culture. Acculturation, as I mentioned before, in a hybrid office environment post-COVID is extremely challenging. And in order to be able to address this, you have to identify some of the key cultural milestones or edicts that you feel or believe represent the corporate culture that you need to stress. And when you're looking at a return to work, even if it is a hybrid environment, make note of these cultural aspects and find ways to emphasize them in potentially the compressed amount of time or face time that employees might have with one another. And there are different methods for doing this, but one of the key things to do is first understand how your culture better affects in a positive way your employees and your workplace and your retention. Compensation. Compensation is also one of the key things we see in studies that's being cited by many individuals as a reason for changing positions. So it is important to do surveys on a regular basis within your industry and within your region, but also being mindful of the fact that when you might have just looked at what compensation packages look like with competitors in your particular geographic region, because of hybrid working environments, now potential employees have access to compensation packages and structures in other regions and other parts of the world. And that's something that you have to take into account when you look at that in your equation. Retention and motivation. Professional motivation, something else that we've seen also in our practice, but also anecdotally, is a main reason why there's uncertainty or potential movement of employees if they don't see a future for themselves in the organization. Some organizations are constructed more flat than others, so there's less room for employees to move around. So they must, in order to advance, potentially move laterally to another organization. Paying attention to this and identifying some of these things are extremely important in the larger aspect of employee retention. And some of these aspects that we're mentioning here have actually come directly from some of our client examples internally. Managing transition. The transition back into the office environment. We just heard from the previous speaker about some of the challenges that companies face with respect to vaccines and trying to be able to control safety in terms of pandemic or COVID safety inside the workplace. Managing all aspects of that transition, both the physical safety as well as the emotional and mental security of employees, does help significantly with respect to quelling or reducing the amount of attrition that you might have during this period. Risks pertaining to corresponding concerns are also popping up, and we're seeing quite frequently in a lot of the ERM programs that we oversee. Institutional knowledge and preservation of its continuity. One of the main things that you have to look at, especially if you're working in multinational companies where you have subsidiaries, you have cross-border offices or locations, is cross-cultural fluency and how changing or removing or transitioning employees back into either a hybrid work environment or losing teams affects your ability to maintain cross-cultural fluency, which is extremely important for teams to work together and allowing for internal efficiency, especially within a larger organization. Succession planning and transfer of knowledge. The threshold issue that you must address in terms of succession planning and transfer of knowledge is identifying the key individuals in teams who you do want to retain. One of the main issues when you're looking at retention is you have to come to terms with the fact that as you may be losing employees during this period, some of the employees that you're losing might not be detrimental to your organization, whereas others may be extremely detrimental to your organization. So understanding who are and what are the key teams or groups of employees, understanding their concerns, and tailoring your efforts to retaining them, the individuals or groups of individuals that are most important to your organization, is an important distinction. Because if you try to accommodate everyone who might have issues or concerns with respect to either working environments or the ability to advance or the ability to be mentored in an organization, you're not necessarily focusing your efforts on the individuals or the key talent that will actually move your business forward and increase your ability to perform. So there is some level of discernment that must take place when you're looking at altering or making any changes internally. Correlating the organizational plan in terms of what you want to do as a company, long range, strategically, with individual development and succession planning, similar to what I just talked about before, is very key. So you don't want to head into a situation like this and make adjustments inside your organization to improve retention and to transfer knowledge until you understand what it is that actually forwards your larger, further reaching strategic plan. You don't want to be reactionary, which is something we see some companies doing, and it isn't necessarily good in the medium or the long term. Control measures, things that we actually see companies doing right now to be able to address some of these issues. Once again, identifying critical roles in key positions, a threshold issue, looking at the adequacy of offers and compensation, and making sure that inside the organization, you're still maintaining internal consistency and equity. Because while you might be satisfying one contingent inside your organization by changing compensation and different type of offer packages, if there is an internal equity, it might dissuade other individuals inside the organization from staying there, and they might seek opportunities elsewhere because they don't feel like they're being treated fairly. Documentation systems for loss of knowledge, having a systemic approach, having a standard operating procedure to be able to actually document information and knowledge so that it is not solely vested in an individual. An individual who can leave the organization is extremely important. And using ERM systems to be able to achieve that documentation and monitor its progress and be able to set milestones is an important way to utilize ERM tools. Adaptation of work hours and working conditions, technology and connectivity for remote workforce. That's a sore point that we see come up. And actually, interestingly enough, is something that frustrates workers who are working in a hybrid environment if they don't have adequate technology and connectivity for their remote environment. Recognition and career development, softer factors, not necessarily compensation directly, but recognition and the ability to develop oneself from a career standpoint are also important mitigating factors. Engagement, both in and outside the office with remote workforces, knowledge transfer process, which we talked about, as well as having mentoring programs, especially during this period of time when you might need to feed the pipeline of junior talent because you foresee the fact that more senior talent might be leaving. And having a mentoring program without, however, having a corresponding responsibility or mandate for senior talent to transfer their knowledge to junior talent or junior individuals, if you don't have the two of them working together, it's not really that effective. And that's something to be mindful of as well. Managing employee expectations, very important. As we mentioned before, some employees are key in your organization, other employees are less so. So managing the expectations of all of your employees and where they sit inside the organization is also an important endeavor. And having robust virtual onboarding, especially if you have a hybrid environment or you have certain social distancing or restriction requirements based upon your physical environment. So in closing, ERM and having a robust ERM risk culture, and I know, like I said, tomorrow there'll be a session where you'll be talking about that, is extremely important to help support the changes that are happening in a COVID environment, especially to the very important, but sometimes hard to address asset that is considered to be human capital, okay? And loss of talent and institutional knowledge, it's important to understand that that can threaten growth and success and significantly erode and dilute critical corporate culture. And corporate culture is one of the key things that allows for systems internally to be able to work effectively and for strategy and goals and longer term planning to actually take place. And if you erode that in its entirety, or at least in part in some significant way, and having key individuals and key leaders leave organizations is a way that can happen, it's an uphill battle and it's hard to recover from that in a timely fashion. Thank you. And obviously, if you have any questions later on, I'll be available.
Thank you, Michael. Because we're running out of time, we just have a couple of questions. This one for Dr. Saidan. What significant differences do you see in Kuwait government approach mitigating COVID-19 compared to the rest of the world? And then something about the cost, but I think the first question is more related to you.
That's an interesting question. Well, one of the things that make us different is that we're a small country and we're more flexible with managing the pandemic than having larger countries that have dispersed populations all over the world. Oh, sorry, all over the map. But of course, this is a challenge on its own because you have a lot of dense areas where people are living. So of course, being able to mobilize our resources very quickly was a benefit of how things are organized in Kuwait. And lastly, I think the infrastructure that was available in the healthcare sector and the resources were sufficient enough to be moved around and mobilized to prevent significant mortality because of exceeding any limits of the healthcare system.
Thank you, Doctor. We had a question from much earlier from one of the deputy CEOs, KOC. Was the pandemic on any company's risk register? Maybe the answer it is now. And was it a black swan? For those that not familiar with the black swan term used in risk management for unexpected or unforeseen risks, because the black swans did not exist in the Western world till the Dutch explorer in, I think, 1697 went to Australia and found black swan. So whenever we refer to a black swan risk that we did not expect it, my humble opinion, I'll let the guys answer it. No, shouldn't be a black swan. We had pandemics before. We will have pandemics in the future. It's just how we manage it. So maybe, Michael, you want to address that question? Was the COVID-19 a black swan risk?
From a human capital perspective, I think in some ways it was in certain industries and certain segments. I can definitely tell you that in the insurance industry, for example, it was not a black swan event. It was something they thoroughly anticipated and were able to prepare for many years in advance because they kind of learned from the SARS epidemic, quite frankly. But in other industries, most industries, I would say it caught a lot of people off guard. I don't believe that will be the case moving forward. I think people will expand the scope of what they believe is likely or possible from an event scenario perspective. But I think for many industries, say for the insurance industry globally, it was a bit of a black swan event.
Okay, thank you all for your valuable input. We will now take a break for prayer and lunch, whatever you want to do. And we'll see you all again at 12:30. Thank you.